Good afternoon, Mr. Ashok.
Good afternoon. How
Afternoon,
are you all
sir.
doing today? Afternoon. How are we all doing today?
I'm doing
Very
fine,
well.
thank you.
Yeah. All right. So we'll just get into that immediately. Okay. So we'll be taking derivatives today. So in the last class, we started with the derivative instrument and the market features, basically. So we're talking about the what derivatives meant, and we said from the word it derives its value from an underlying asset. And we spoke about the different types of underlying assets that we can have, equity, commodities, and the likes. Then we spoke about the derivatives markets, which is the very important one that we spoke about, where we said we have two types of markets, the over-the-counter and the exchange-traded derivatives. And we spoke about the different characteristics of those markets, where we said the over-the-counter market is more like two people just coming together to say, okay, I want to exchange this for this. So we said that market is more customized because you can easily say, one of the examples we gave last class was we're looking at a country that is facing a currency exchange risk. For example, you are in Nigeria and you need to buy something in dollars. So you are facing a currency exchange rate risk in the fact that the price can be, the exchange rate today can be 800 and the exchange rate at a future date, let's say 3 months time, can be 1,000. How do you hedge, or how do you reduce your risk or manage your risk between that 800 and 1,000? So you know your obligation, you are buying something for 1 million naira. So for you, you are looking for 1 million naira in 3 months time. You are not looking for anything more than that or anything less than that. And you are not looking for a period lesser than 3 months or a period more than 3 months, because your obligation is in 3 months time. Let's say you want to get a phone, for example. You want to get a phone abroad and you want to get it in 3 months time. So anybody that gives you the what you need before that time is not necessary for you. You actually need it at that time. So that's why we said over the counter is more specific and customized. You can customize it to what you want. Then we spoke about the exchange traded derivatives. And we said this one is more like a standard market. So in this market, there are rules, there are players, and there are regulators, people who monitor both what the buyers and the sellers are doing. And of course, we said if you have a market where there are regulators, there's actually going to be a fee that you are going to pay. So in this kind of exchange traded market, there needs to be, because we mentioned another thing, what we call default risk. Because in the over-the-counter market, you are just two people. One person can decide not to go ahead with what you have agreed with. But in the exchange traded market, that doesn't work. Because at the end of the day, if you decide to run away, what happens to the other person? So this exchange traded market reduces the impact of the credit default risk, because there's a regulator who now says, you, the buyer, you have to drop some money. You, the seller, you have to drop some money. And then, so if any of you decides not to go ahead with it, that money you have dropped, I'll give it to the other person to at least reduce the risk of default, basically. Then we said exchange traded derivatives are also standardized, in the sense that you cannot just come and say, like the person that wants to get 1 million, 1 million, to purchase something in 3 months' time, it may be difficult for you to get that in an exchange traded derivatives at a go, because exchange traded derivatives are specific. They have they are standardized. They have exactly how things are going to pan out. We also spoke about the clearing system. I think we'll talk more about that today. Yeah, so that's basically for the exchange traded and the OTC. That's the general idea of that. Okay. So we'll go into, because we also mentioned that there are two, we mentioned the forward commitment and the contingent claim. So now we'll talk about the features and the instrument of those things. If you remember, we said the forward commitment is that you have said, I'm committed to do this. So as the word is, commitment. So in this case, you can't run away. You have said, I am going to do this. But the contingent claim, as the word says, contingent. So it's based on a particular event happening. So one of the best examples of contingent claims are what we call options. So what that means is that you have an option to say, I am going to take this or I'm not going to take this. That's what the option is. And that's the contingent claim. But for the forward commitment, you have said, this is what I'm going to go ahead with, basically. So we have to look at the features and the instrument of those transactions. Okay? Are you guys still with me?
Yes.
Okay. All right.
Yes, we're with you.
Okay. So here, so this is our second reading, basically, for those that are just joining, because I can see, I think, one new person. Okay. So we've defined forward contracts and futures contracts before, basically. So the main thing we're talking about now are the swaps and the options, and to look at them in more detail, basically. Okay. So here the forward contract says, in a forward contract between two parties, one party, which is the buyer, commits to buy, and the other party, the seller, commits to sell a physical or financial asset at a specific price on a specific date in the future. The buyer has long exposure to the underlying assets. Okay, I'll get to that. So this now says two people come together and say, okay, I want to buy this for 100 naira. So let's say Ini comes and says he wants to buy a phone, iPhone 14 for, let's say, 800,000 naira. And he says, I want to buy that phone in 3 months' time. So he goes to Esther. Esther says, okay, no problem. In 3 months' time, I will give you that phone and you will give me 800,000 naira. They agreed the deal today. So we're in September. So let's say December. In December, they agree that Ini says, so the contract is, Ini has agreed to give Esther 800,000 naira. Esther has agreed to give Ini a phone, an iPhone 14. That's the contract. So that is one person agreeing to sell, another person agreeing to buy. Remember, the value is 800,000. So let's say we get to December and they have released iPhone 15. And then it's 3 months time today. They now say, okay, what is going to happen? We agreed 3 months ago, or we agreed in September that you would give me, Esther tells Ini that we agreed that you would give me 800,000 naira. I will give you the phone. Now it is December. It's time for us to fulfill our obligations. Both of us have agreed to do something. So what if the cost of iPhone 14 in December is now 1 million naira. So in this transaction, who has gained and who has lost? Is it Esther or Ini?
If the price is now 1 million in December, Ini has won because, oh sorry, he has gained because again he's going to buy the gift, sorry, the phone for 800,000 naira.
Exactly. So I think some people were off. So I'll repeat the question and I'll repeat the answer. So Esther, you're correct. So the question, the statement of the question was, Ini has agreed today to buy a phone from Esther in December for 800,000 naira. So my question was, what if December comes now and the phone is now 1 million naira? Who has gained and who has lost? So actually, Ini has gained because he's now buying a phone worth 1 million naira for 800,000. And on the other side of it, Esther has basically lost because she will now go to the market and go and get a phone for 1 million naira and give the phone to Ini, who will just give her 800,000. So she has lost 200,000 basically. So the idea is for Ini to agree to buy, the phone. It means at a price that is agreeing today. It means he believes that the price is going to go up in the future. So he's trying to hedge himself. So Ini believes that this phone is 800K today. Most likely, with the way the country is going, this phone will be more expensive than 800. Let me look for somebody that I can transfer this risk to. In the sense that, okay, if the phone goes to 1 million like it has gone to, I don't need to worry about the extra 200. It's not my business. It's the other person that will worry. Then you ask yourself the question, why is Esther going into this transaction if she's going to lose 200,000? Nobody knows what is going to happen. So they are both on two sides of the equation. It could have easily been that the phone now drops to 600,000 because, as it happens, a new phone has been released. So people are not really buying the old phone again. So if the phone has dropped from 800,000 to 600,000, it means Esther is the one now gaining 200,000 and Ini is losing because Ini has committed to, that's why you see his forward commitment. Ini has agreed to buy the phone at 800,000. So even if he goes to the market and he hears that the phone is 600,000, he cannot back out of this commitment because he has agreed to do that. So that's what. So Ini is going in. So Ini is going to buy because he believes that the price is going to go up. It goes the other way around. So if I flip the example now, and Ini wants to sell is a car, for example, and Ini says, okay, the car today is 2 million naira, and he wants to sell it to Michael. And he tells Michael, I'll give you this car. I'm going to leave Japan and I'm leaving the country in 2 months' time. So in 2 months' time, I'll give you this car for 2 million naira. Let's agree today that in 2 months' time, I'll give you this car for 2 million. And then Michael says, okay, no problem. So in Michael's mind, is buying a car for 2 million. Michael is agreeing to buy it at that price because he believes that maybe in 2 months' time, this car will be more expensive than 2 million. This is a good deal for me. Ini is agreeing to sell it today for 2 million naira in the future when the transaction will occur. Because he says, if I don't sell this car now, 2 million, in 2 months' time, I will be begging somebody to collect 1 million. Let me just sell it now. So the two parties believe that they are going to make a gain when they enter into this transaction. That's the idea. So when Ini is selling that price for 2 million, he's selling the car for 2 million because he is afraid or he believes that the price of that car will go down. So he's saying the earlier I can lock the price of this product at 2 million, the better for me because he thinks that the price is going down. If Ini believes that that price of 2 million will keep going up to 2.5, 3 million. Ini will not go into that agreement today. He will wait till that time and sell the car for 3 million, for example. But because he believes that the price is going to go down, that's why he is going into that transaction today. So I'm trying to give you this overall explanation because that's basically the foundation of all these things we are talking about. The foundation of knowing the reason why that person is buying and the reason why the person is selling. Okay? Do you guys understand the example? Any question?
Understood.
Okay, good. So, so the buyer, so here it says the buyer has long exposure to the underlying asset, in that he will make a profit on the forward if the price of the underlying at the settlement date exceeds the forward price. So it's just big English. This is basically what we have said. So the buyer, let's take the example of Ini selling a phone to Esther. Ini buying a phone from Esther, sorry, for 800,000. So Ini is the buyer. So in this case, the buyer has a long exposure to the underlying assets, in that he will make a profit on the forward if the underlying at the settlement date exceeds the forward price. So the forward, it will make a profit on the forward. The forward is that price at the 3 months time. The price in December, that's what we call the forward price. So this forward price is that price in December, not the price today. And then the underlying is the value of the assets. So in our example, the underlying of the assets is 1 million naira. Remember, it was 800,000 naira the day Ini and Esther went through this transaction. But now, as at the forward time, which is the 3 months time has come now, the value of the assets, which is the underlying, at the settlement date. The settlement date is that forward time, which is December in this our example. And that settlement date, the value of the asset has now gone to 1 million. Now the question is, that 1 million, does it exceed the 800,000 naira we agreed 3 months ago? That's what this is saying. So in that case, he will make a profit. Remember the explanation I gave you. Ini is going into this because he believes he will make a profit. If he doesn't believe that the asset is going to go up, if he doesn't believe that the value of that phone is going to go up, he will not go into that contract. If he thinks, okay, this phone, the price will go down, then it doesn't make sense. Does it make sense for Ini to go to Esther today and say, oh, I want to buy the phone for 800,000? If Ini knows that in 3 months' time, he can buy that phone for 600,000, it doesn't make sense. Instead of doing that, he will just say, okay, I won't do any deal with Esther. Once it's 3 months' time, when I need the transaction, I just walk into any shop, get my phone for 600,000, and I'm good to go. So what you need to understand is, when the buyer decides, so what you see, long exposure here. So I think I explained last week. Long is when you are buying, short is when you are selling. So you are buying because you believe that the value of the asset will go up. So you want to hedge against that effect today. That's the idea. Okay. So that's the profit Ini is going to make. That profit of 200,000 is the profit he's hoping to make because he believes that the value is going up. So remember this example, we'll use it when we're talking about options. But let me just take it here. So this is the commitment, forward commitment, which we have said Ini cannot back out of this. So he has committed to take it, to buying the phone from Esther for 800,000, irrespective of what the price, the forward price is. I'm now using the terminologies here because I've explained. So in the case of options, options now gives you, as the word says, options. It gives you a chance to either walk away or continue. So in the case of an option, let's assume Ini and Esther went into an option and not a forward contract. not a forward commitment. What does that option mean? It means that, still same example, Ini would buy a phone from Esther for 800,000 by December. But the added thing now that the option brings is, the option is Ini can decide to walk away or Ini can decide to continue. Then you ask yourself the question, what's Esther going to gain? Would Ini just come today and tell her, I want to buy, I'll buy a phone from you in December for 800K. And then after some time, he just walks away and doesn't come back. So what is Esther's gain in this transaction? Why will Esther even ever agree to do this? So for the case of options, you have what you call a premium. So what happens is Esther says, okay, you want us to carry out this deal, right? No problem. There's a premium that you have to pay. The premium you have to pay is 50,000. What does that mean? It means Ini has to give Esther 50,000 naira today, not in 3 months' time. Ini has to give Esther 50,000 naira today as that transaction is starting. So Esther will hold that 50,000 naira irrespective of what happens. So that 50,000 naira is like a cost of the option to Ini. What does that mean? It means that, going back to our example, we said the option is, the first one is if Ini wants to buy 800,000. We now discover that the future price is 1 million. So it means that at the end of the day, Ini will go to Esther and say, oh yeah, let's carry out our transaction. I want to give me the phone for 800,000. Because Ini sees that he's gaining in that case. Because 800,000 is cheaper than 1 million. So it's a good deal for Ini. So what we call it in options here, we call it exercising your options. So Ini will exercise his option, which is he will go ahead with the transaction that was agreed 3 months ago. So Ini goes to Esther and says, okay, Esther, give me the phone. And Ini gives her 800,000. So it means the total costs for Ini is that 800,000 is given Esther and that 50K he has given her before. Because Esther will not give him that 50K back. 50K is like the cost of transaction. So meaning the total money Ini is spending in that transaction is 850K. And he will be happy. Why would he be happy? Because he's comparing 850K to the 1 million he will have bought that phone in the market. So 850K is far better than 1 million naira. So he's okay with it. So that's scenario 1. Scenario 2, still the same examples, but now instead of 1 million naira, the phone is now 600,000 for whatever reason. So the question is, does it make sense for Ini to go back to Esther and say, okay, let's continue with that transaction, or I'll still buy it for 800K? It doesn't make sense because he can easily walk to the market and buy it for 600K. So at that case, it means Ini will not want to go ahead with the transaction. That means he will not exercise his option because it is not worth it to him. So what would Ini do? Ini will walk away from that transaction. So the only money Ini is going to lose is that 50K he has given Esther from the beginning. So you see the two sides to it. He's not going to come back because he doesn't feel. So the first thing you need to ask yourself is, the future price, does it favor this person buying? What that person will call the call. Does it favor the buyer? If the price favors him, then yes, it will go ahead. If it doesn't favor him, he will cancel it. And once he cancels it, it's only that premium, which we call option premium, that he has put down. That's the only thing he's going to lose. Is that clear?
Yes,
Did you guys
clear.
understand?
Yeah.
Okay. All right. So that's for this. Then the futures contract was also spoken about this. So this futures contract is similar to the exchange traded funds. So you can see here that the futures contract is standardized and exchange traded. So this one is standardized, just like all the examples we've mentioned before from the beginning. But now in being standardized, remember I said when you come into this transaction I've explained between Ini and Esther can be seen as an OTC, over the counter, because it's just two of them. So the truth is, in that transaction, there's a risk of default. Except investor can trace Ini's house and all those things, but there's a risk that Ini will run away and not come true. Or Esther will run away. Esther too can run away because Ini can transfer the money to her and will not see Esther again. Esther will run away with 800K. So there's a risk there because it is over the counter. It's just two of them doing their transactions together with themselves. But the futures contracts, which is the exchange traded one, you cannot run away like that. So what they do here is to find a way to be able to commit, for people to have commitments. Remember, the commitment I mentioned before was only for options, which we'll get to, which is the 50K. But the normal one before the option, there's no commitment. It is just we are agreeing to do something. But if it is a futures contract, we will not now be talking about Ini and Esther alone. We'll be talking about Ini to the company. Let's call it a financial intermediary. So between Ini and the financial intermediary, and then the financial intermediary versus Esther. So in fact, Ini and Esther will not even know they are talking to themselves. Ini is just coming to buy something. Esther is coming to sell something. Just like let me say Jumia, but at least you can still trace yourself in Jumia. But an app where you just come and say, I want to buy something, and so people are just selling. From the beginning, you don't exactly know who you are buying from or who you are selling to. You are just coming into a market to express your interest, whatever it is you want to do. So that's what this exchange traded fund is. So there are now a couple of things that happens here. So one of those things is, so let me just read this. The futures contract is similar to forward contract, but it's standardized and exchange traded, which I've spoken about. The primary ways in which forwards and futures differ are that futures trade in a liquid secondary market. Remember, I've also told you guys about this liquidity. In the exam, liquidity should be the last thing you use to pick your answer. Because like I said, the two markets can be liquid. So I've mentioned this, so you have to be very careful when it comes to liquidity. The things that are certain, that are differences between futures and forwards are one, the greater regulation. So futures and forwards are like OTC versus ETD, basically. So for futures, you have greater regulation. You trade the market with more disclosure, so there's transparency. Remember, it's a market where so many people are in, so information has to be freely available to everyone. So greater regulation, transparency. Then futures are backed by a central clearing house and require daily cash settlement of gains and losses so that counterparty credit risk is minimized. So this is one of the key differences between futures and forwards and between ETDs and OTCs. So this future, you see that now you have a central clearing house. So of course, at the end of the day, when you have a body, there's going to be charges at the end of the day because somebody is performing this job. When it was just Ini and Esther, there was nobody following up with the both of them. There was no intermediary. But now that there's an intermediary, there are going to be charges. So you ask yourself the question, why am I going through intermediary? Ini will ask himself, why is he going through intermediary when he can easily go to Esther and do the deal he wants to do? But he can't really do that, or he can decide not to do that because of the credit risk default. The risk of default of either party is high. So at the end of the day, if you are doing, remember I said these stuffs are volume driven. So if somebody that is doing 1 billion naira transaction will not want to play with doing it with somebody he doesn't really know because he wants to save himself from 50,000 naira, 100,000 naira charges versus 1 billion naira. So he prefers to go to where he knows that his money is safe and secure. That's what futures give you. So there's a central clearing house. So what the central clearing house does is every day, So remember that I take us back to our example of 800K and 1 million, or 800K and 600K, depending. So as of today that Ini and Esther have agreed to exchange a phone and money, what is the price of that phone today? So let's say the price of that phone today is 900,000. But Ini has agreed to go for 800,000. So what this clearinghouse does is, on a daily basis, they look at the changes in that phone. So let's say the price of the phone today is 900,000. Tomorrow, the price of the phone is 910,000 naira. There is a 10,000 naira difference between the price of yesterday and the price of today. That 10,000 naira will be a gain or a loss to somebody. So I need you guys to think about this now. Give me an answer. So I'll repeat the question so that we understand everything. Ini is buying a phone from Esther for 800,000. The current price of the phone is 900,000. The phone has now gone up by 10,000 naira. As at that day that the phone has gone from 900 to 910,000, who has gained? Is it Ini or Esther that has gained? So think about it and explain your thought process. Should I start calling names?
Can you
Sorry.
say one more time?
Yeah, the time.
Say that again.
Can you
It's
say
by
it one more time?
okay.
Okay, I should repeat the question. Okay, so you have Ini is buying. Okay, let me just see if I can hear this. Just 1 minute. Okay, so Ini is buying from Esther. So Ini is paying Esther 800,000 naira. Right? The value of the phone today is 900,000. This is the value today. And then Ini agrees to pay Esther 800,000 in 3 months' time. So the timeline for this is 3 months. The timeline for this is 3 months. Then this one is today. Now, so the value of the phone is 900,000 today. In 3 months' time, Ini has agreed to buy that phone from Esther for 800,000. I'm now saying tomorrow, this phone now becomes 910,000 naira. So already the value of the phone has gone up by 10,000 naira. So my question is, this 10,000 naira, is it a gain? Who is it a gain to? As at tomorrow. So you are thinking about it that, okay, what if tomorrow is the future? Sorry. What if tomorrow is the end of the contract? Who would have gained as at this time and who would have lost?
Hey, can I try, sir?
Yes, please.
Okay.
Yeah, me. Ini will be the one that gained.
So Ini says the buyer will gain.
Yes, Ini will be the one that gains.
Okay, so Esther, you are going with Ini will gain as well, okay? Which is the buyer.
Yeah. Yes,
Okay.
exactly.
Any other answer?
Okay, good afternoon, sir.
Good afternoon.
Yes. So if we're looking at it tomorrow, not in 3 months' time, I think Esther will gain because the value as of today is 900, and by tomorrow, the value will be 910,000. So the 10,000 naira gain is a gain for Esther as at tomorrow, but not in 3 months' time.
Okay. Any other contrary answer? Okay, you have explained the two answers. Michael,
Yes,
what do you
sir.
think?
Yeah, I think Kini will gain because he's buying at a price lower than the current and future market value.
Okay. So to answer this in breaking it down, let's ask ourselves why did Ini enter this transaction? Ini entered this transaction because he believed that the price in the future would be high. So he doesn't want to buy at that high price. He wants to buy at a lower price. So let's assume that this 910 is the final price at which, let's say they are settling the transaction tomorrow. So it means that Ini will go to Esther and give her the 800K. So this is Esther, this is Ini. So Ini will be minus 800K because he's going to pay Esther the 800K. Esther will receive that 800K, which is a positive for her, but she has to get a phone for Ini. And how much does the phone cost as at that tomorrow? The phone costs 910,000. So it means that Esther has to go and look for 110,000 naira extra to be able to get the phone that she has agreed to give Ini for 800,000. So Ini is gaining, which is the buyer is gaining. The buyer is gaining because something that is worth a higher amount is buying it for a cheaper price. So because as at this day, the value of the phone is now 910,000. Because he has agreed this deal before, he will just go to Esther. He won't go to the market like every other person and buy the phone for 910,000. No. He will just walk to Esther and say, Esther, oh yeah, it's time. Give me my phone. And Esther says, okay, I'm coming. Remember, Esther does not just have that phone in her house. Esther doesn't have the phone in her house waiting. She has to go to the market and buy it as well. So Esther will have to go to the market. In fact, she has to first look for the 110 first before she even buys the phone. So she has to carry 910,000 naira because that is the value of the phone as at this tomorrow that we are talking about, which is now today in court. So she has to carry 910,000 naira to go and buy something and only collect 800,000. So she is losing 110,000 like that. Do you understand? Loveland, do you understand? I hope I've
Yes.
not. Okay. Okay, so that's the idea. So, like I said, remember the reason why one person is entering the transaction, which is Ini who is the buyer. Ini is agreeing to buy something in the future, but he's agreeing it today because he believes that that future price will be very expensive. So he's agreeing to buy it today so that expensive price in the money in the future, he will not spend it. He will only spend the money he has agreed today. So I flip this example again. So if this price tomorrow is 700, So if the price is 700, it means automatically who has gained? Esther is gaining and Ini is losing. Why? If the deal ends that tomorrow at 700,000, Ini must pay Esther 800,000. But Esther is just going to the market with 700,000 to bring a phone. So she will go to the market with 700,000 because that's the price of the phone today. When she goes to the market, she gives them 700,000. They give her a phone. She carries the phone and she goes to give Ini. Ini will give her 800,000. 100,000 is her money. Just like a middleman effect. So if you people are used to what do you call it? People that do things for people at the end of the day. So you realize that they always like to add their commission. So they say, my commission on this is 10% or is 5%. That's my commission. But agreeing the price from the beginning. So let me give you an example. If you want to repair your car and the mechanic says, oh, the cost of this part is 100 naira. And you say, are you sure? He says, he's sure. I say, are you sure? Okay, fine. You send him 100 naira. If he goes to the market and the price of that item is 120 naira, it means he will have to bear the 20 naira extra. All you want is for you to get your parts. So it's the same way here. So you always have to think about who is gaining, who is losing, and why. Okay? Do you guys understand the example?
Yes, sir.
Okay. All right. So these futures now tells us that the futures are backed by a central clearinghouse and require daily cash settlement of gains and losses. So this explanation I gave you now. So the daily settlement. So that extra 10,000 between the 900 and the 910, that extra 10,000 will be paid in this our example will be paid to Ini because Ini is the one gaining, and it will be taken out of Esther's money. So Esther's money will reduce by 10,000. Ini's money will gain by 10,000. So there's also something called initial margin. What does that mean? Before they go into any of these transactions, before anybody goes into a transaction in this futures market, you need to put in, let's call it like a deposit. You know, there are some transactions that you have to put in a deposit. So in some cases, you put in whether you want to transact or not. This is the deposit you must put first before any conversation can be had with you. So in this case, it is called an initial margin. Okay, this is it here. Initial margin. This is the amount of cash or collateral that must be deposited in a futures account before a trade may be made. So it means Ini must deposit initial margin, Esther must deposit initial margin. Why are they doing that? Remember I said that this exchange traded markets is ensuring that there is little risk of default. So what this market does is there is an amount that two of you must drop first today. Yes, you agree to do a transaction in 6 months' time, no problem. But the fact that you are coming into this market, you must drop a particular money, whether you are buying or you are selling. So everybody must drop that money into the market first. That's what you call the initial margin. So it's from this initial margin that 10,000 naira in our example will be taken from one party and added to the other party. Remember that this exchange traded derivatives has a financial intermediary in the middle. So I've said for this one, you have Ini on the left, you have Esther on the right, and you have an intermediary in the middle. Let's say myself, I'm the intermediary. Ini is on the left, Esther is on the left. So I go to Ini and I say, Ini, you want to do a deal. Ini says he wants to buy phone. Ini is not concerned about who he buys phone from. He just wants to buy phone. Okay, no problem. I tell him this is the market rate. Esther says she wants to sell. And I tell her this is the market rate. I say, for you guys to come into this transaction, Ini, you have to give me 5,000 naira. Esther, you have to give me 5,000 naira. That is the initial margin. Now, on a daily basis, we'll calculate as the market is moving, as the phone price is moving from 900 to 910 to 915 back to 900, as it's moving, going up and down, I'll be taking money from one party and giving the other party in that initial margin. So the person that gave me 5,000, if there's a gain of 2,000, his money will go up to 7,000. Person that gave me 5,000, I will take the 2,000 from that person and reduce to 3,000. So at the end of the day, the 5,000 from the left, 5,000 from the right, which is 10,000. Everything must still balance 10,000 because I'm taking from one person and giving to the other. So that is what we mean by initial margin. Okay. On a futures exchange, margin is cash or other acceptable collateral that both the buyer and the seller must deposit, which I've explained. So the other thing I want to explain is, okay, yes, at the end of the trading day, the margin balance in a futures account is adjusted for any gains or losses in the value of the futures position based on the new settlement price, a process called mark to market or marking to market. So this is what I just explained. On a daily basis, I pick up whatever difference the market has based on the value of the underlying. There is a difference in our derivatives. That difference is 2,000 naira. I adjust it from the two parties. So one person is losing, one person is gaining. So there is what you call a zero-sum game because one person's loss is another person's gain in the market. That's basically what it is. So every day I am settling that. So that's what you call daily settlement. So on a daily basis, I am settling that difference. Now there's something you now call maintenance margin. So this maintenance margin is, remember, using that example, I've said the initial money you must give me is 5,000 naira. That's the initial margin. But now there's a maintenance margin. What does that mean? Just like this one is now called minimum balance. The minimum balance that you must have in your account. So if I say the minimum balance anybody must have is 1,000 naira. So I will keep taking and adding to any of the parties until any of them drops to 1,000 naira. So let's say the first transaction, Ini is gaining, Esther is losing. So Ini's money will move from 5,000 to 7,000. Esther's money will move from 5,000 to 3,000, which is the 2,000 net. Let's say, for ease of example, the next transaction is 3,000 naira again for that day. So Ini has gained another 3,000. So Ini will move from 7,000 to 10,000. And then Esther's 3,000 will now become 0. So remember at the end, if you add the two of them, it's still 10,000. But now Esther's balance is 0. Esther cannot have a 0 balance. Esther must have a minimum balance, which is the maintenance margin. So I tell her that your you have exceeded the money in your account. So there is something they call a margin call. So you call Esther to say, Esther, you need to top up this your balance. And remember, she's topping it up to her initial margin. So she's topping it up to 5,000. She's not topping it up to 1,000. 1,000 is just the minimum balance. So Esther must bring another 5,000 to balance the account. If, for example, Esther only had 800, which is less than the 1,000 minimum balance, Esther will now have to give me 4,200 to add to that 800 to take her back to 5,000, which is the initial margin. Okay, so here it says maintenance margin is the minimum amount of margin that must be maintained in a futures account. If the margin balance in the account falls below the maintenance margin through daily mark to market from changes in the futures price, the account holder must deposit additional funds to bring the margin balance back up to the initial margin account. That's why I said you must take us back to that 5,000. So you must bring money that will take you back to that 5,000. Or the exchange will close out the futures position. So if you don't bring that money, then that transaction has ended for you. basically. Okay, so do you guys understand? Do you guys understand the maintenance margin and the initial margin? If I go to the example.
Yes, I understand it.
Okay. All right. So this now, so let's take this example. To illustrate the daily mark to market for futures, consider a contract for 100 ounces of gold that settles on May 15. The initial margin amount is 5,000. So this initial margin means this is the money that you must bring in first into the market to be able to do any transaction. So without that minimum balance, you can't do anything. So if you notice in some investments, those of you that do some of all these mutual funds and some of all these other investments, they'll tell you that there's a minimum amount for you to have an investment. So this initial margin is the money you must put in first before you have any money less than 5,000 naira. You can't even start a transaction in this case. So the initial margin here is 5,000 naira. The maintenance margin is 4,007. What does that mean? It means that your balance must not fall below 4,007. So every day we are removing and adding your money based on market movements, but it must not fall below 4,007. Any day it falls below 4,007, we will inform you and you must top up your money to the 5,000, which is the initial margin. Okay? So day zero, the buyer and seller make a trade at the end of the day at a price of 1,950 per ounce, and both parties deposit the initial margin. Okay? So transaction now starts. The price agreed is 1,950 and the initial margin is 5,000. So on day one, the settlement price falls to 1,947. The seller has gains and the buyer has losses. You understand this? Because this is saying that the person that bought this gold, he says he wants to buy it at 1,950. Remember, the reason the person is buying is because he believes there will be a price increase in the future. If he doesn't believe that, then he will just calm down and go to the market and buy on that day. So this buyer has gone into this deal for 1,950 and already day one, the price of the asset has already fallen. So the difference between 1,950 and 1,947.5 is the loss to the buyer. So the buyer has already started losing money. The seller is already gaining, which is the same example I gave you guys. So if the day ends in this day one, for example, it means the seller will go to the market, buy the assets for 1,947.5, give it to the buyer who will give him 1,950. That difference between the two is the seller's gain and the buyer's loss on that day. So very important thing I want you to note, and you should write it somewhere. The buyer would always gain when the price goes up, and the buyer will lose when the price comes down. And it goes the other way as well. So in this case, you see the buyer has already lost or has started losing because it's just day one. The buyer is losing because already the price has gone down. So what would the exchange do? Because this is not over-the-counter transaction. Over the counter, they will not be doing daily movements. Esther and Ini they don't have the time every day to say, okay, well, give me 20 naira today. Price has gone up 20 naira. Okay, the next day, you give me 50 naira. Yeah, okay, you give me 100. They don't have that time. Two of them will just wait until the date of the transaction, the 3 months time or whenever they've agreed, and they will do their transaction. But for exchange traded funds, every day, they will be doing daily settlements. So for that day one, the seller will get 1,950 minus 1,947.5. The 100 is because the 100 is the quantity. But if you forget the 100 for a minute, it will be 2.5. So 2.5 naira is what you will add 2 times the 100, gives you the 250 you see here. So this 250 will be added to the seller. So you now see that the seller now has 5,250. The buyer because that money will be taken from the buyer. The intermediary is not spending his money. It's just bringing two people together. So the buyer would now, that 250 that you're taking from, that you're giving the seller will be taken from the buyer. So the buyer would have 4,750. The seller will have 5,250. If you add those two things together, it takes you back to the same 10,000 they both started with, which is 5,000, 5,000. So as a total, they would always be the same. That's why it's called a zero-sum game. Nobody is gaining more than or losing more than the other person. You are just taking from Peter to pay Paul. That's basically what it is. So the exchange would deduct the 250 from the buyer's account. So the buyer now has 4,750. Then automatically the system will do a check. 4,750 that you have today, is it more than the maintenance margin? So 4,750 is more than 4,700. You are good for the day because the balance you have is more than the maintenance margin. So nobody will call you. We move on to the next day. So the next one is now day 2. For day 2, the price falls again to 1945. So what does it mean? As it's falling again, the buyer is still losing, the seller is gaining. So 1947 minus 1945 times 100. That's another 250. So the seller is gaining another 250 again. So plus that 5,250 he had before, you add 250 again, which takes it to 55. So the seller's money has gone to 55. We go to the buyer. That 250 will be taken away from the buyer. The buyer had 4,750 before. If you take out 250, it takes the buyer to 4,005. So again, the system will do that check. This 4,005, is it greater than the 4,007 maintenance margin? Obviously not in this case. So a call will be placed to the buyer in this case. So the buyer must deposit. So that's why I said the buyer will not just deposit 200 naira. Sorry, $200 to take it back to 47. No, the buyer will deposit 5,000, which is the initial margin, minus this 45. So the buyer will have to deposit $500 to take him back to that initial margin. So at the end of day 2, both parties have futures position at the new settlement price of 1945. So at the end of the day, you realize that the buyer has lost 2 times. So net, the buyer has lost 250 and 250. He has lost 500 from his 5,000, basically. Okay, do you guys understand the movement? So we've spoken about initial margin, which is the first money you bring. We've spoken about the daily settlement, which is one person's gain is another person's loss. So as you're adding to one person, you are taking out from the other person. We've spoken about how you need to know one person is gaining or losing, which is very important. So for the buyer is gaining when the price is going up and losing when the price is coming down. And then you now have the last one, which is the call. So the buyer or the seller will be called when the money they have has dropped below the maintenance margin. And once it drops below the maintenance margin, what you are supposed to do is you are supposed to top up the money back to the initial margin. Okay, is that clear?
Yes, sir. It's clear.
When we get to questions, we'll know whether it's truly clear. Okay, so any question for me? Okay, I move.
Sorry, sir, I have a question, sir.
Okay, good.
Yeah, so at the end of the day, how would this now adjust to the actual price that the buyer should be paying?
Yeah, so for this one now, if we assume that the transaction ended at 1945, it means at this 1945, remember they started at 1950.
Yes.
So at this 1945, what's his name? The buyer has lost.
Yeah.
The buyer has lost 1950 minus 1945, which is five naira per ounce, basically.
Mm.
5 times 100, which is 500. So the buyer has lost 500 and the seller has gained 500, which is what has been broken down in 2 days here. So what this thing is doing is breaking it down. So you see, day 1, he lost 250. Day 2, he lost 250. Total, he has lost 500 and the seller has gained 500.
Okay.
You get?
Okay.
So the transaction has ended there. So the net effect is the 500 gained and the 500 lost. One person versus the other person. So that's why you see that the buyer here is depositing that extra 500.
Okay.
You get? So the difference between this one and the forward is that it's not this detailed into day by day. What just happens at the end of the day is that the day the transaction is due, the seller will go and buy the product at 1945 times 100, basically. And then the buyer will give him 1950 times 100. That difference is the 500. That's the money the seller has made. Good to go. So this one is just a lot more detailed to get to that same, it's the same conclusion, basically.
Okay. All right.
Okay. So also in the futures, you have what you call, so many futures contracts have price limits. So what price limits mean is they have, as the word says, limits. Exchange impose limits on how much each day's settlement price can change from the previous day's settlement price. So what that means is there's a maximum amount. So any amount higher than this, you will not be allowed to trade. So this is exchange members are prohibited from executing trades at prices outside these limits. So what that means is some exchange, because you see now we've said 250 day 1, 250 day 2. This 250 could have easily been, for example, 500,000 naira difference. So some exchange says 500,000 difference is far more than the initial margin you have put. You have put 5,000. So for somebody, if they are calling him to bring 450k extra compared to calling somebody to bring 500 extra, it's not the same. If you call somebody to bring 450k extra, the person can run away and say he's not doing again. And therefore, in that case, the default risk which you are trying to reduce by going into an exchange will not really work. So what these people do is some futures contracts, they will have a limit so that the loss, the maximum loss that one person is suffering would make sense, will not be too much, that the person will just run away and leave the contract completely. And even if the person does leave the contract completely, that initial margin that the person has will still be able to cover the impact of the person running away. So that's why some futures contracts have this price limit. Also, if the equilibrium price at which traders will willingly trade is above the upper limit or below the lower limit, trades cannot take place. So it's the same thing. While you have an upper limit, you have a lower limit. Some exchanges also have circuit breakers. In this case, when a futures price reaches a limit price, trading is suspended for a short period. So what that means is you have said you have a limit. So after you have achieved that limit, okay, we are at that limit now, what do we do? Some futures will say, okay, let's give it a short time. It can be 3 hours, it can be 6 hours, depending. So let's give it a short time. After this short time, we now come back to the trades and we see that, okay, pricing of this has changed. We can now go ahead to continue with our trades based on that.
Sorry,
Okay?
sir.
All right.
Please, can you explain this price limit thing? Maybe with these numbers in this example above.
Okay, so let's assume that.
I also
so,
want to say you should shed more light on the price limit. Use the example above. Thank you.
Okay, so let's assume. So in this. Okay, so in this example, you won't have a price limit because transactions have taken place. But let's assume that the price limit for for this was, let's say, because every day here was $25. So let's say $2,000. Let's assume $2,000. That's a bit high, but let's just assume $2,000 was the price limit. What does that mean? It means that the difference between 1,950, which is the price they've agreed from the beginning, and the price of that day. Okay, let me use $1,000. Let me use $1,000. So it means that if the price of that day falls from 1,950 to $900, that means this difference will be 1,950 minus 900. That's 1,050. That is higher than the price limit. So meaning that the trading will be suspended because that difference in price is higher than the price limit that they have set. Do you understand? Or should I take it again?
Okay, sorry. The price limit is dealing with this 250 after they do the calculation, Abi, what they get.
Exactly, yes.
So another question I have is that is it that they will suspend it or they can just choose to trade at that limit if it's above it, or they will not just trade at all?
No, once it is above that limit, they will not trade.
Okay.
So that's where you see that in this case, that's why, okay, so these are exchange imposed limits on how much each day's settlement price can change from the previous day's settlement price. So it's the settlement price we are talking about. So that difference in price, if the gap between the two is too significant, so some will say, okay, this transaction for the day is cancelled or is paused until the price goes back to a normal price where the gap is not too much. So they are prohibiting you from executing trades outside these limits.
So can we
Do you
say
understand?
the price limit is set to reduce the amount of loss that could be suffered by any of the counterparty?
Exactly. Yes. That's it, to reduce the loss. I remember, like I
Okay,
said,
sir.
if the
Thank you,
loss
sir.
is too much, yes, if the reason why they set it is the loss can be too much that somebody will run away. And remember that this exchange traded stuff is to reduce default risk, which is default risk is risk of somebody running away and leaving the contract like that without fulfilling his part. So if the loss is too much, normally that's why you have this initial margin. This initial margin is like initial deposit you must have. So if anything happens, they can touch this money and settle the other party. But if the loss is too great compared to the money you have dropped as initial margin, then I cannot settle. It will be difficult to settle the person. If for example, the gain between the 1 and the 2 was $5,000, for example, the initial margin here is $5,000, which probably would have gone down by the first day. Okay, so as at the first, the initial margin was 4,750, which is the margin balance. So if the gain was like 10,000, for example, then the other party will just run away. The buyer will run away and say it's not doing again. The seller will come to the exchange and say, okay, yeah, buyer. In fact, the seller is not even concerned about the buyer. Remember, they are both dealing with intermediary. So the seller will just come to the intermediary, which is the exchange, and say, okay, how far my contract now? What's happening? The intermediary cannot now be telling him, oh, you know that because today it was a serious loss, so the other party has run away. No, it's not his business. So I take it back to the betting example. Sorry for keep using that. Well, I think it's quite appropriate. So I think there was a time that maybe it still happens though, but there's a time online that it was trending that somebody used whether 50 naira or something ridiculous to win over 20 million or another very ridiculous amount. But it was both a ridiculous amount that he put in the bet and a very ridiculous amount that he won. So the betting company cannot come and be telling him stories that, oh, sorry, you know that people that actually bet from the other side, okay, maybe he bets to win. They will not tell people that actually bet to lose. They were not plenty. Oh, so we cannot, that's not his business. His business is, I have won my money, give me my money. So it's exactly what happens here. And some betting companies also have a limit. You cannot go and put 50 naira and come and win 100 million naira. You cannot kill the company, even though the probability of it happening is low. But if it does happen, it means you have shut down the whole company. So it's the same way it happens here. That's why you have an intermediary. That's why it's called exchange traded derivatives. The intermediary, you are not concerned about what's happening on the other side as the seller or the buyer. Your concern is intermediary, when it's time to pay me my money, pay me my money. So remember, the price limit means that one person will make loss. It also means the other person on the other side will gain. So while the person that made loss is running away, the person that gained is walking in majestically to ask for his money, which the financial intermediary has to pay. So this price limit is to kind of protect that okay, oh, the gap must not be too much. Because if the gain or the loss for the day is too much and the person runs away, is the financial intermediary that will bear it. Is that clear?
Yes, sir.
Very well, sir. Thank you, sir.
All right. Okay, so quickly, let's answer question 1 and 2. The keyword is quickly.
Question 1 is futures contract.
Future.
Okay. Futures contract, yes. But there's something I wanted to add as well. Sorry, before we go to number 2, something I wanted to add. So yes, number 1 is futures. But there was something else we mentioned briefly. We mentioned something called central clearing party earlier, where I said that clearing party is almost like an intermediary. So it's possible that a forward contract can have a central clearing party. So just to chip that in, it's possible that a forward contract can have a central, which is rare, but it's possible that a forward contract can have a central clearing party, which almost makes it like a future. What that means is, I think I also gave that example as well, where I said, okay, we want to do, I think I used Man U and Chelsea the last time. Yes. That may Larry says Man U is going to win. And then someone else says, Michael says Chelsea is going to win. And I am in the middle. And I say, okay, I want to settle the two of them. I want to be the intermediary. So in that case, in quotes, I can be a central clearing party. So because I'm that central clearing party, it's possible that I can be doing this mark to markets on a daily basis. That's the only comma you have here. So you are right in terms of futures contracts, but just have it in your mind that if there's a central clearing party as well, that central clearing party may do this mark to markets, but just have it somewhere. But you are right in your answer, which is futures. Okay, number 2.
Number 2,
Counterparty risk.
counterparty risk.
Okay, very good. So thank you for not falling into the trap of liquidity. So the forward contracts involve the counterparty, which is very clear. So that one is not debatable. The counterparty risk and the transparency are not debatable. So you can tilt towards that. Liquidity, always be very careful. It can be great in one side, it can be less in one side. It's not exactly clear, but the transparency and the counterparty risk are very clear. Okay, good. Okay, so that is all for forward commitments. Any questions from that side? Okay, so we are now moving to swaps and options. Now, I'll have taken options first, but okay, let me just go with swaps. So swap is very easy. As the name says, you are swapping something for something. So one of the main things about swap is that there is usually interest rates. So most swaps are usually interest rates. What does that mean? Let's say I'm owing Michael 10 million naira and I'm supposed to pay him 10% on a monthly basis. I have that obligation. So obligation to pay Michael 10% on a monthly basis for 10 million, which is 1 million. That one is clear, no problem. I will now say, oh, I want to swap. What am I swapping? I will go to the market and let's say Damilare is the market. I'll go to Damilare and say, okay, Damilare, I want to get an interest rate that is not fixed. You know, I have a fixed interest rate with Michael, which is I must pay 10% every month. So I'll go to Damilare and say, okay, I want to get what we call a floating interest rate, or an interest rate that is not fixed, or a variable interest rate that varies with the market. So as the market is changing, the interest rate will be changing. So I now want to swap my fixed payment to Michael of 10% to a floating or a variable interest rate with Damilare. So that if the interest rate in the market for that month is 8% versus 10%, there's a 2% difference. One of us will be 8. If the interest rate is 15% versus the 10% I'm paying Michael, so there's 5% extra, one of us will be 8. That's what this swap is. So I'm swapping one interest rate versus another interest rate. That's basically what this is. Okay, so swaps are agreements to exchange a series of payments on multiple settlement dates over a specified time period, e.g. quarterly payments for 2 years. At each settlement date, 2 payments are netted so that only one net payment is made. The party with the greater liability at each settlement date pays the net difference to the other party. So just like the example I gave, if the market rate is 8% and there's a 10% obligation, it means there's a 2% difference. That 2% has to be paid by one person. And vice, so that's what you see here, that the net difference is paid to the other party. Swaps trade in dealer markets and the parties are exposed to counterparty credit risk unless the market has a central counterparty structure to reduce counterparty risk. In this case, margin deposits and mark-to-market payments may also be required to further reduce counterparty risk. So these swaps can be like forwards, or they are basically forward commitments, really. But they can also have that counterparty. I mentioned that central clearing or central counterparty who will take on this risk. And the moment you have a central party, that central party will ask you to drop something. So is that something that you drop? Like I explained from the Man U and Chelsea, I will collect the money from Damilare, I'll collect the money from Michael. I will keep the two money. So one person says, oh, 5,000 naira for Man U to beat Chelsea. The other person says 5,000 naira for Chelsea to beat Man U. They will both transfer the money to me. I will be the one holding the 10,000 naira. So if any of them tries to run away, no problem. I have the money with me. So I am the central person. So that's what this is saying here as well. Okay, we can illustrate the basis of swap. It is simple fixed for floating interest rate swap. for 2 years with quarterly interest payments based on a notional principal amount of 10 million. In such a swap, one party makes quarterly payments at a fixed interest rate, which is the swap rate, and the other party makes quarterly payment based on a floating market reference rate. So you have two parties. One party is paying a fixed rate, the other party is paying a floating rate, which is the example I gave. I'm paying 10% and the market is 8%. So there's a 2% extra which will be paid. The swap rate is set so that the swap has zero value to each party at its inception. So remember what we said from the beginning. For forward contracts, the contract between Ini and Esther from the beginning, nobody is dropping money from the beginning. They are just agreeing to do something. So at that beginning, there is no value. There is no value to either party. That's what this is saying. Swap rate is set so that the swap has zero value to each party at inception. So from the beginning, nobody has more money than the other person. But as time goes on, like we have seen, as time goes on, one person, if it is a daily mark to market, one person is gaining, one person is losing, until the last day when we now come and say, okay, transaction is over. So as expectations of future values of market rates change over time, the value of the swap can become positive for one party and negative for the other party. Still the zero-sum game I explained to you guys. So using numbers now, consider an interest rate swap with a notional principal amount of $10 million, a fixed rate of 2%, and a floating rate of the 9-day secured overnight financing rate. Don't worry, there is just too much English. Don't worry about it. So what it means is principal amount is 10 million, fixed rate is 2%, and floating rate will be given to us. It's a 90-day floating rate. So they will tell us what the rate is every 90 days. That's what this is saying. So don't worry about the English. So at each settlement date, fixed payment is 2% because they said 90 days. 90 days is 360 divided by 90 is 4. So that's why you see this 2, because this 2% is annually. So 2% divided by 4 times 10 million. So the fixed payment is 50,000. Just like the example I gave of owing Michael 1% of 10 million, which is 1 million. So every month I must pay Michael 1 million. So this example is saying every month you must pay 50,000. Sorry, every 90 days in this example. Every 90 days you must pay 50,000. So this is the fixed payment. So remember, I want to swap this fixed with a floating payment. That's the swap. Swap is to exchange one thing for the other. So the floating rate, so your fixed rate is not changing. That one is sure. Is the floating rate that is changing. And that's why you're coming into this contract. The floating rate payment at the end of the first quarter will be based on the 90-day blah, 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 blah. So the cocoa is that at the end of the first quarter, the rate is 1.6. So all this English is just stories. What it is telling us is that fixed rates was 2%, floating rate is 1.6%. That's the only thing that has changed. The value of the principal has not changed, 10 million. The period has not changed, 90 days. The only thing that has changed is that I'm swapping one rate. Instead of paying 2% fixed, I'm now paying a floating rate, meaning that this period now, the rate is 1.6. I can come another period, the rate will have changed to 1.8. Another period, the rate will have changed to 2.5. That's the only thing I'm doing. I'm swapping one fixed rate to a floating rate. So at the end of the first quarter, the floating rate will be still, so everything remains the same. So where it was 2%, I divided it by 4. Now is 1.6%, I divided by 4 again, times the same 10 million. So this is 40,000. So in the floating rate, I have 40,000 to pay. But in the fixed rate, it's 50,000. So meaning there's a difference of 10,000. Somebody has to bear this 10,000. It's not going to go in the air. So the fixed rate payment is again 50,000 because that doesn't change. So at the end of the second quarter, the fixed rate payer will pay the net amount of 10,000 to the other party. What does it mean? The person that is paying the fixed rate, his 50,000 will not change. But now the rate in the market is 40,000. So there is an extra 10,000. So it's the other way around. If, for example, the floating rate here was 2.5%, for example, it means that the payment here would be maybe, let's say, 80,000. So there will be a difference between 80,000 and 50,000. So the person that is paying 80,000 will pay more, will pay the net to the other person. Let me see if we have. So you have the thing that is important here is that one, the rates are changing. You are moving from a fixed rate. So instead of me paying Michael 1 million, 1 million, 1 million every month, I will go to Damilare and say, okay, every month I want us to look at the exchange rate. I want us to look at the interest rate, sorry, in the markets. The month where the interest rate is 0.5, of course, it doesn't pay me. It doesn't pay me because I already have a commitment of 1%. But the time where the rate is 1.5%, it pays me because Damilare will give me 1.5% and I will only give Michelangelo 1%. So that difference, one person has to pay the other person. So in this case, the fixed rate payer, because he's paying more, will pay the floating rate payer the 10,000 naira, $10,000 difference. A company with 2-year floating rate quarterly pay notes outstanding could enter such a swap as the fixed rate payer, converting its floating rate liability into a fixed rate liability. It now makes fixed rate payments and then uses the floating rates from the counterparty to make the payment on its floating rate debts. By entering it into this swap, the company can hedge the interest rate risk of their existing floating rate liability. So you are basically moving from one to the other. So the key thing you have to understand in swap is one of the best example of swap is that it's interest rates. Two, it is a series of payments. Remember, I've been saying I'm making payments monthly or I'm making payments quarterly. So swap is a series of payments. Three, it is that I'm moving from floating to fixed. I'm moving from fixed to floating in terms of my interest rate. Four is that the interest rate is the market reference rate. The floating interest rate is the market reference rate because I'm believing that as the market is changing, my interest rate will be changing accordingly. Okay? Is that clear? Okay. So it says, as we see in our reading on swap valuation, a swap can be constructed from a series of forward contracts in which the underlying is a floating rate and the forward price is a fixed rate. So swap can be likened to a forward contract. Remember I said swap is a type of forward contract as well. So it also has that default risk and everything, except where there's a central clearing party. Remember that. But without a central clearing party, a swap is just like a forward rate that has possibility of a default, is agreed on inception to be paid at a future time, blah, blah, blah. But for the swap is like series of forward contracts. So the first payment is a contract. The first payment, which we said 2% and 1.6, we move to the next quarter, the next 90 days. Maybe the next 90 days now, the floating interest rate has moved to 2.5. That's another new contract. We move to the next 90 days, it has moved again. So that's why you see swaps are called series of forward contracts. basically. So each forward settles on one of the settlement dates of the swap. At each settlement date, the difference between the fixed and floating rates will result in a net payment, just as with a swap. Often, interest rate forwards settle at the beginning of the quarter rather than at the end. The cash flows are the present value equivalent of the end of the quarter swap payments. You don't need all those ones. So those things are what you need. You are moving from fixed to floating or floating to fixed. Swap is a series of forward contracts. It's equivalent to a series of forward contracts. A swap involves the floating rate of a swap is linked to a market reference rate, basically. And then, just like a forward contract, at the inception, there is no value. The value at the inception is zero. Is as the contract now goes that one person is gaining, one person is losing. Okay? So other swaps as well, you have credit default swaps. This one too is also very simple. What it means is that you are transferring the risk of defaults. So for example, Loveline is owing me money today. And I'm not sure whether she will pay or she can pay. I'm not sure. So I go to Michael and I say, Michael, I want to enter a swap with you, which is if Loveline defaults, you will pay me so amounts. Let's say she's owing me 50,000. I go into a swap with Michael and I say, okay, if Loveline defaults, you will pay Michael, you will give me 40,000, for example. Michael says, okay, no problem. So I've swapped my credit risk with Loveline with a contract with Michael. So remember, the reason I'm doing that is because I believe that she's going to default. If I believe she's not going to default, I won't go into such a contract. I'll just wait. When it's time, she gives me my money and I move on. But now I'm going to a contract with Michael. And of course, Michael believes that Loveline will default. Sorry. Yeah, Michael believes that Loveline will not default. Sorry. Since I believe Loveline will default, Michael believes Loveline will not default. So that when Loveline doesn't default, he will collect the 50,000 from Loveline and give me 40,000 and make 10,000 naira just by being in the middle as a middleman. So that's what this credit swap is. Because in the credit swap, I'm moving one payment to another person if on the event that something happens, because I believe that the credit, in this example, Loveline is going to default. Okay, so one type of swap that is structured a bit differently is credit default swaps, CDS. With a CDS, the protection buyer makes fixed payments on the settlement dates, and the protection seller pays only if the underlying has a credit event. This could be a bond default, corporate bankruptcy, or an involuntary restructuring. So it will only pay me if there's a credit default. So when the credit default occurs, the seller must pay an amount that offsets the loss in the value of the security. The fixed payments represent the yield premium on the reference bond that compensates bondholders for the expected loss from default. So you don't need all these ones for this level. So what is important is that the CDS is that I am hedging against the fact that I believe that there will be a credit risk in the future. So because I believe that I'm not going to get my money from the person that is owing me, therefore, I go into contract with another person, and that person will pay me only if that other person defaults. So basically, okay. Any questions?
I want to ask.
All right.
Now, credit risk default will be like is like an insurance against default. I mean,
Exactly.
okay. So, how does the market really operate? Because, for example, you told us, okay, the example you gave us is like if Lovin believe maybe I will default on the $50,000 credit she gave to me. Now, imagine the huge amount that I tell him to give me $40,000 out of the 50. If he give me $40,000, how much will I pay to him to give me such an insurance in case there is no default? I want to just understand, bring that into limelight, just explain a little bit.
Okay, so insurance is the key word. So let's look at insurance. In a situation of, so for anyone who has car insurance or anything has happened to car or phone, for those that have phone insurance. So if your car is worth 2 million naira, for example, the insurance will say you pay a premium. Premium will be at, let's say, 10% of the value of your assets, for example. So you'll be paying 200K, which is a lot, yeah, but let's just assume. So let's assume 5%, which is 10,000. You'll be paying that on a yearly basis. Now, or let's say 10%. Sorry, that money looks small. Let's say 200,000. You'll be paying that on a yearly basis for the value of a car that is 2 million. Now, you believe that nothing, you hope, you, the owner of the car, you hope that nothing will happen. But you are saying in case anything happens, somebody will cover my loss. The insurance on the other side is praying that God, let nothing happen. Let nothing happen to this car. Remember, whether something happens or nothing happens, you are not collecting that 200K back. So the insurance company already has that 200K as their money that they are keeping. So if something happens, first of all, they will investigate till kingdom comes to be sure that you did not cause it, because they are going to have to pay through their noses for that. But because it is a wider business for them, net they will gain, because if they are getting 200,000 naira from 5,000 people and only 1 or 2 people have an issue with their car, so on a net basis they are making a lot of money. So they are able to pay out huge sums to one person. But if 5,000 people insure and 5,000 people have problem, insurance company has closed down. So that's basically from the insurance perspective, but that's how this works. This person you are swapping with believes that there won't be a default, or is hoping as well that there won't be a default. So he's taking a bet that, okay, this your debtor will not default. So I'm willing to take up that pain. You that want to go into a credit default swap, you are paying a premium. You are paying a premium on that to the person. So that person is keeping that your premium. So whether it's default or it doesn't default, that person has chopped that money. But you believe that if this person defaults, the loss I will gain is greater than this premium I'm paying. So let me pay this premium, it's better. The insurance company is hoping that there won't be a default. So, but if there's a default, the insurance company will have to pay you to cover for that. So it's all bets and it's all probabilities. Do you understand that, Larry?
Yeah, thank you so much. With the idea of
Yeah.
insurance, I got it. Thank you.
Yes, that's it. So if you have ever dealt with insurance, you will see how very strict they are when it comes to payouts. They will check
Yeah,
almost everything.
in fact, it's always a lot. Thank you.
They will check almost everything. So I was even watching a movie some days ago, and so these people have a house insurance, but apparently the house caught fire. So the first thing that came to my mind was, it's not Nigeria now. These people should have house insurance. Why are they panicking? It's just to go to insurance company, let insurance company reimburse you. And they went to the insurance company, and the insurance company said, we've done investigation and we discovered that you left a candle on in the house. So because you left a candle on in the house, we are not able to reimburse you. And I was like, now wow. But it also shows, which is the truth, insurance is not happy to pay you, because the money they will pay you is far more than the money you have been paying them. So that money has to come from another place. Because you that you have insured, you are happy. Something worth 100 million, for example, you can be paying 10K for something worth 100 million. How many years will it take you to pay the 100 million, for example? But if something happens today, you will go to insurance company and expect the insurance company to give you 100 million. Where do you expect that money to come from? So it's the same way. It's the same way as this default one. One person is hoping and believing that it's not going to be bad. It's just like factoring. For those that understand what factoring is. You have a debt. You believe that this debt is going to be bad. Somebody comes and says, don't worry, this debt is not going to be bad. How much is the debt? 100 million. Okay, give me a particular money. I'll go and recover the money for you. What he believes. So it's the same way that works as well. Okay? All right. So we move to, so I've explained forwards, I've explained futures, I've explained swaps. I hope those are clear. So we move to options. I've also explained options before, but options is now under the contingent claim, which is you can decide to, so I use the word exercise, but not exercise. But in plain English terms, you can decide to go ahead or not go ahead. Going back to our example of Ini and Esther, yes. Ini has agreed to buy phone from Esther for 800,000 naira. By December. December comes and Ini realizes that the phone in the market now is 600,000. Ini just tells that, sorry, I'm not going to go ahead with it. And he moves on. So in that case, he has not exercised his option, but he has an option. It's not like forward contract where he doesn't have an option. Those ones are commitment. You're obligated. But this one is a right. It's not an obligation. You are not forced to go ahead with it. And like I said, the other party is not a momo that you'll be playing with up and down. The other party has to gain something. You cannot come today and say you are doing it. Come tomorrow, you say you are not doing. There has to be something I'm going to gain to be in this, to take that risk from my side. So that's where you have that premium. So this option is different from the other ones we have mentioned, because from the beginning, there's a premium that is paid so that one person cannot, even if the person says he wants to run away, we consider that premium. And the example I gave you guys the other time, I said if the premium is 50,000, so meaning Ini has given Esther 50,000 already. So that 50,000 is almost like non-refundable payments. Let's put it that way. So imagine you are going to, I think there's a place, okay, there are places on the island where you go and you play some games. For you to be able to access those games, you need to buy a card or something. Once you have bought card, you have already paid money. You can't return card. They've charged you the card. If you now come and say, oh, all these games you people have, I don't like them. Say, oh, sorry, madam, there's nothing we can do. They can't give you your money back for the card. So it's up to you to decide whether, should I go ahead to play this game or I should not go ahead to play this game. But they must gain something. So that's where the premium comes in. Okay, so option says there are two types of options of interest to us here, which are put and call options on an asset. We introduce them by using 100 shares of stock as the underlying asset. So there is put and there is call. A call option is to buy. A put option is to sell. That's the basic thing. So when I'm saying Ini wants to buy phone from Esther, it means that Ini is going to do a call. The person that is going to sell is going to do a put. So call is to, as you are going to call with your hand to come, means you are buying, you are receiving something. A put is that you are selling, so you are putting something down to sell. If that helps you understand that. Okay? And we mentioned something. I said any that is buying, would it, okay, so I asked the question again. Back to the example. Ini is buying a phone for 800,000 from Esther by December. Why is Ini going into that transaction? Is it that he believes that the price of the phone in the future will go up or the price of the phone in the future will go down? It's a question for the class.
Price will go up. That's definitely why you want to buy, want to pay for, want to enter into the contract now, because you believe the price will go up in December.
Exactly. So he prefers to go into the contract for 800,000 because he believes that the price will go up to maybe 1 million or 1.2 in the future. So he pays him to buy at 800,000. So when everybody is panicking and going to the market to say, now wow, things don't go up for 1.2 million, he says, he's not worried because he has agreed 800,000 with somebody. So he just goes to that person and collects his phone and moves on. Esther may not be smiling when she's doing the deal, but Ini is not going to look at her face. We have agreed 3 months ago. Just give me my phone. Thank you. And he walks away. So that is an example of a call. So if we swap it to a put, which is a sell, if Damilare is selling to Loveling, let me use two different people so that you don't mix up the example. So if Damilare is selling a car to Loveling, and Damilare says, I want to sell this car for 2 million naira by December. Damilare is going into that transaction today because he believes that that car will be less than 2 million naira in the future. So he wants to cash out today. So you say that the put or the sell is the opposite. He's going into that put because he believes that there will be a price decline in the future. While for the call, Ini is going into it because he believes there will be a price rise in the future. I hope that's clear. So a put option gives the buyer the rights, but not the obligation to sell 100 shares at a specific price. So the right and not the obligation means that no difference between right and obligation. You have right to, what do you have right to do? As I always say, you have right to freedom of speech, but what happens after it is not a different case. But you have the right to do something. Obligation means that you must do it. Right means you can decide to, and you can decide not to do it. So that's what this option is. So he has a right to sell at a specific price. That price, so the price I've been giving you in the example, the 800,000 I said Ini is going to buy from Esther, is it 1 million I used? 1 million that Damilare is going to buy from Loveling. That price is called the exercise price or strike price. So that is the price we are agreeing for a future transaction. We are agreeing that price today for a future transaction. That's what is called exercise price. So am I going to exercise this transaction at this price or I'm not going to exercise it? That's where the right and the right comes in. For specific period of time, which is the time to expiration, the put seller takes on the obligation to purchase the shares at the price specified in the option if the put buyer exercises the option. What does it mean? So for the put was the example of Damilare and Loveling. So Damilare is agrees to sell to Loveling at a particular price, 1 million naira, to sell a car to Loveling at 1 million naira. Damilare is the buyer of the put option. Don't let that confuse you. Damilare is the one selling, so that's the put. Put means sell. So Damilare says, I want to get an option. I want something to give me the right to sell. That's Damilare buying a put option. So he says, okay, now I have the put option, which is the right to sell. Loveling on the other end comes to say, okay, yes, I'm the person you are going to sell, Abi. Good. I'm the person on the other side of the equation, which will buy the car. Who will buy the car? Sorry. So Damilare has the right to sell the car. Damilare can come in 3 months' time and say, oh, the value of this car in the market is 800,000. He paid me to go and complete my deal with Loveling. So Damilare goes to Loveling and says, Loveling, okay, it's time. Oh yeah, take my car. Give me 1 million naira. At that point, Loveling has an obligation. Remember, she's not the one that bought the put option. It's Damilare that has the put option, which is the right to sell. Loveling, on the other hand, has the obligation to complete the transaction. So Loveling must collect that car, whether she likes the car or not. She must collect that car and give Damilare 1 million naira. So that is that. Automatically, that one is settled. Okay, so if Damilare now says, oh, the price of the car, it goes around and it says, but I've priced this car. This car is 1.5 now. Hey, what am I going to do? Damilare just calls Loveling. Loveling, I know I told you I was going to sell that car to you. Sorry, I can't sell it again. Don't be angry. Because Damilare has the right, it is fine. The contract has ended then. Loveling does not have any rights to do anything, to tell Damilare that, no, you said you must buy that. Because Damilare is the one that has the rights. Loveling cannot do anything in that case. So like I said, you ask yourself, what is Loveling gaining in this situation? But it looks like she's losing everywhere. Remember, I now mentioned the premium. That premium, Damilare must give Loveling a premium from the beginning of the contract. So at least Loveling has one small money in her bank account. If Damilare like, it should mess up. If you like, it should not mess up. Please, this 50K in my account, I will flex with it. So if Damilare calls and says, okay, go ahead, she will go ahead. But if Damilare says he wants to go ahead, Loveling cannot say she's not going to go ahead. That's the obligation. So I need you to understand the two parts. So that is the put, which is the seller. If you swap it, you have the buyer, which is the Ini and the Esther case. Ini wants to buy from Esther the phone. Ini has the rights. Esther has the obligation to sell the phone. So Ini comes and says, okay, Esther, let's go ahead with it. Esther must give him the phone. If Ini says, Esther, I'm not doing again, Esther must calm down and collect that premium she has. She will just enjoy that one. So that is where that's the explanation of that. Okay, so note the one-way nature of options. If the exercise price of the put is $25 at the expiration of the option, and the shares are trading at above $25, the put holder will not exercise the option. So this is similar to the example we have given. The price they want to sell these shares is $25. The price they have agreed is $25. But the market is at 25 or greater than 25. So it doesn't pay this person to sell a product at 25 naira when he can get more than $25. So he doesn't exercise and he goes to the market to buy. There is no reason to exercise the put and sell shares at 25 when they can be sold for more than $25 in the market. This is the outcome for any stock price greater than or equal to $25, regardless of whether the stock price at option expiration is $25 or $1,000. The put buyer lets the option expire and the put seller keeps the proceeds from the sale. If the stock price is below 25, the put buyer will exercise the option and the put seller must, you see is must purchase 100 shares for $25 from the put buyer. On net, the put buyer essentially receives the difference between the stock price at expiration and $25 times 100 shares. We'll see this in details in numbers, so don't worry about that. A call option gives the buyer the right, but not the obligation, to buy shares at a specific price for the specific period of time. The call seller takes on the obligation to sell the shares if the call buyer exercises the option. Any questions? I want to be sure you people are following me. I know I've explained this call and put kind of before, but is it clear?
I'm processing it too.
Okay. We'll continue while you process it. Okay. All right. So here we're asked to determine the value at expiration and profit from the long or short position in a call or put option. So we have, remember I've said we have, okay, let me go back to our Excel. Okay. So we have 800,000, which we have said is like the price at which INI wants to buy. So INI has an option, a call option, right? INI has a call option to buy a phone worth 800,000 from Esther. So INI is the call buyer. Esther is like the call seller. Basically. Okay. So INI has the option. So let's look at the possible option. So let's now say there's a premium. So who can tell me what I said this premium is?
That's the amount that Esther will pay to Ini for the transaction to hold in case Esther default. So it will belong to Ini since it's a call option. So Ini has the right. Esther has the obligation.
Is that correct? Michael, is that correct?
Oh, not as I don't know. I didn't hear the part of this premium, but I know I had them the part of the excise price. So I don't know if that's what you're referring to.
Okay. Esther. Okay, Ini, go ahead.
I think I'm the call buyer, so I have the advantage. I'm the one paying the premium to Esther.
Exactly. So Damilare, you started well, but you didn't finish well. The person that has the rights is the person that is paying. Remember, the person that has the obligation is already, let me not say losing, but is already in a disadvantage. Yes, I think that's the word. He's already at a disadvantage because he's obligated to do something. So that's the person that must gain, that must have something. You can't be obligated and still pay premium again. No. So the person that has the right is the person that is paying that premium. Because the person that has the right can walk away. So in this example, Ini is saying, I am going to buy a phone from Esther. I'm going to buy a phone from Esther for 800,000 as an option, meaning he has the right, okay, he has the right to buy a phone or not to buy a phone from Esther. So automatically, Esther is at a disadvantage because Esther does not have control. Ini is the one that has all the control to buy or not to buy. Okay, so Ini is the one paying the premium of 50,000. So let's go to scenario 1. So in scenario 1, we assume that, good. So this price of 800,000, what did we call it? What term did we call it?
That should be the exercise price.
Exactly. Thank you. So this price is exercise or call price. Sorry, or strike price. Sorry. Exercise price or strike price. So the exercise price is 800,000. This one is not, is locked. We've locked this one. And we said this is going to happen in 3 months' time. Or let's say December. December is almost here. So scenario 1, we're in December. And underline, the underline in this example is phone. So underline price, which is the price of the phone, is now 700,000. So at this point, will Ini exercise his right or will he not exercise his right? Hello.
He will not.
Exercise his
He will not exercise his right.
Wait, I'm hearing different things. Lovely, please, can you give me your answer again?
He will. He will.
He will.
Yes.
Okay. Michael.
He will not exercise his
Fantastic.
right.
Fantastic. Esther. Esther, are you still reading the question?
No, I'm here.
Okay. Do you have an answer for me?
Sorry, I think I missed the beginning, the inception of the whole question, so I'm not really
Okay.
in here.
All right. Ini, exercise or not exercise?
I'm coming on.
Okay. Damn, Larry, exercise or not exercise? Hey. All this I
He will not
understand.
exercise his price.
He will not exercise. Okay.
He will
Ini
not.
is what Esther we are using for this example. So if people are
Yeah,
supposed to.
he won't exercise it.
Okay, why?
The reason is because
I didn't get
The
that.
price.
Ini, can
Hello?
you take it again? Yes.
Yeah, I think he will exercise his price because the price of the underlying has gone down
Okay.
and the
Even though you answered, you don't sound so convinced of your
if you
answer.
exercise his price,
I'm not
if you
sound
exercise his
confused
price at
because
700,
I'm confusing it with something else in my head. That's why I'm sorry.
He will not exercise his price. Sorry, he's right. He won't.
Okay. Why? Why
if you
did you say
exercise
he
his
will
price at
before?
700, he
Lovely.
will
Why
be
did you say he
losing
will before?
100. Okay.
Sorry, hold on,
Okay,
Damilare.
wait.
Lovely. Why did you say he will before?
I didn't really get it, but now it won't because the price is now 700 and he was supposed to pay 800 for it. Okay, no, he will exercise his rights to not buy. So he will exercise his rights.
He will exercise his right to not buy. That's interesting. Okay.
Yes.
Damilare.
Yeah, he will not exercise his right. You know, the right is for him to buy. If he want to exercise his right at this junction, that means he will be paying 800 for the 700 phone. So Esther will gain 100 more from the premium he had paid previously. So he will be at least a rational human being. He will not want to do that. He will want to wait until the price of the underlying is above what, if it is that third month, if it is above, then he will now he will try to exercise at that point. But at this point, he will not exercise because he will be paying 800, and even the price of the phone is 700 at this point. So that will be unreasonable for him.
Okay. All right. So let me explain some terminologies. So INI has the right to, so when we say exercise, it means to go ahead with what has been agreed. So if you say you want to exercise, in this case, if INI is going to exercise his right, it means he's going to go ahead with buying the phone from Esther at agreed 800K. If he is not going to exercise, it means he's not going to buy it. So I think, Loveling, you got to the answer at the end of the day. But it's either exercise or not exercise. So exercise is go ahead with what you have initially agreed. Not exercise is don't go ahead with what you have initially agreed. So the question is, why would he choose to go ahead or not go ahead? That's really the main question. And we have to look at it from one perspective, which is, what is the value of the item today? So the value of the phone today is 700,000. So if, like I said, we're taking Esther as an Instagram vendor, for example, that you have chatted 3 months ago, that, oh, I saw blah, blah, blah online. I want to buy. Okay, so I don't have the stock today, but I'll have the stock in 3 months' time. So, okay, fine, no problem. When it's 3 months' time, I will buy. So let's take it that, because it's a right. You can decide that you're not buying again or not, but you've given her a commitment, not a commitment, but you've told her that you will likely buy. Fast forward to 3 months' time, and she still says that, okay, you have agreed price of 800,000 with her. But you go to the market today or in your office, somebody is going to say, this phone you want to buy is 700K here now in Computer Village. Why are you going to buy from Instagram vendor at 800K? So, that's the price we agreed to before. Say, So the question is, as a rational person, you want to go for the one that is cheaper, right? So for you to go for the one that is cheaper, which is not Esther, meaning you will not exercise. You will not go ahead with what you have agreed to do with Esther. So you have to not exercise, which is leave Esther and go to the market and spend 700K, which is better than going ahead with your agreement with Esther for 800K. So to answer this, you will not exercise. You will not exercise because the underlying is less than the exercise price. So that's the reason you are not exercising, because the underlying, which is 700,000, the underlying price is less than the exercise price. That's the reason you are not exercising. But now, that Instagram vendor, you've already given the vendor advance of 50K. First of all, you cannot tell the vendor to return your 50K after the vendor has gone to market to buy products for you. You now come back and say you are not doing again. So what's happening? It means that this 50K, which is the premium, in this our example, INI has already given Esther, because INI is the one that has the right to go ahead or not to go ahead. So from the beginning of the transaction, Ini has already given Esther 50K. That, okay, keep this 50K. In 3 months' time, we'll see what is going to happen. And now you are seeing what is happening, and you have said he's not doing again. But remember, you cannot collect, it's not refundable. That 50K is not refundable. So what does it mean? So the question is, in this scenario 1, how much is Ini losing or gaining? If he doesn't exercise? Let me answer that. This is the first time. So at this point, normally, okay, so at this point, Ini is only, because Ini is not exercising the contract, so he's not going to spend this 800K. He will just go to the market and buy at 700K. So the only thing Ini is losing is this premium of 50K, which he has spent. So in this scenario 1, Ini is only losing that 50K he has given Esther as non-refundable money, because he's not going ahead with it. Is that clear? Do you guys understand this scenario 1? If I move to scenario 2.
Yeah, I do.
Okay. Now, scenario 2. Just copy this. For scenario 2, same scenario, but now the underlying price is now 900,000. Let me say 1 million. Okay. So at this point, will he exercise or not exercise?
He will exercise it.
He will exercise. Why is he exercising? He's exercising because if he goes to the market, and goes to buy this phone, he will pay 1 million. But if he sticks with Esther, he will only pay 800,000. So here he's exercising because the underlying price is more than the exercise price. Remember, he's paying, so he's always looking for how he's going to pay the lower amount. So he's saying, it's better to pay 800K than to go and pay 1 million. So I will stick to what I've agreed to do with Esther. So the question now is, what is Ini losing or gaining in scenario 2? So in scenario 2, Ini is gaining 1 million, which is the price at which he would have bought it in the market, minus the 800,000 that is going to pay Esther. That is what? That's 200K. But remember that he had, yeah? Okay. But remember that he had given Esther 50,000. So what Ini is gaining is 150K as a net amount, because now he has benefit of 200K, which is 100K minus 800, versus the 50K he has already given. So he will look at it that it's better for me to buy from Esther, because 800K plus the 50K, that's 850. If I add everything I'm going to spend with Esther, it's cheaper than going to the market. So 850 is cheaper than 1 million. So he will go ahead and do what? And buy from Esther. And he will make a profit of 150,000. So this 150,000 will be seen as a gain. So this 150,000 is a gain to Ini, who is the buyer. And a loss. And a loss to Esther, who is the seller. So let's calculate Esther's loss as a breakdown. So first of all, remember Esther has to go and buy phone of 1 million. She has 800K she will get from Ini, which is positive. So 800K minus 1 million that she has to go and look for to buy the phone. So already she's losing 200K. But remember, Ini has given her 50K. So net, she's going to lose 150K. So this is loss to seller, which is Esther in this case. And this is gain to Ini, who is the buyer. So 150 here, 150 here, zero effects. Remember I said this is a zero-sum game. All right. So is that clear?
Yes.
Okay. Lovely. Is that clear? Do you have any questions here?
It's clear. Thank you.
Okay. So going back to scenario 1, I just wanted to add there. So in scenario 1, Ini is losing. Remember, Ini is not exercising. So because Ini is losing 50,000, I just wanted to chip that in. Esther is gaining 50,000. So you don't forget. So Ini is losing that. Esther is gaining 50,000. So this is an example using a call. Right? So I'm going to give an example. We understand this one now, Abi? Everybody say they understand. Oh. We are going to move to another example with a put, and we are going to answer it together. So stress myself. Okay. So we are going to do exactly the same thing. But now we have a put. So in this case, we used Damilare. So we said Damilare is, and we use 1 million, I think. Damilare is selling a car to Loveland. Damilare is selling a car to Loveland for 1 million. So our first example, let's say the car goes to 1.5. And let's say the car comes to 800. So in this scenario, Damilare has agreed. So he's the put, he's the main person, he's selling. So the put buyer means the person that is buying a put, just like the call buyer is the person buying a call. The call or the put, so the put is the right to sell. So Damilare is going to the market and saying, I want to get a right to sell this car to Loveland. So in this case, Damilare is the one that has the right to sell or not to sell. Loveland has the obligation to collect the car and to pay Damilare his money. Is that clear? Okay. And in this case, we say our premium is 100,000. So I repeat the question again for those that will say they are still reading the question. Damilare is going to sell a car to Loveland at 1 million naira. The premium is 100,000. So who is going to pay who this 100,000?
I think it's Damilare.
Okay. You are sure?
It's Damilare.
Good. Okay, good.
Yes.
All right. So Damilare is the one that has the right. So because he has the right, he has to pay. Because he's putting Loveling already is at a disadvantage. So there must be something she's gaining for her to even be in the room. So Damilare will give Loveling 100,000 first to cool her temper before they decide what they want to even do in December. Okay, so we now get to scenario 1. We now discover that the value of the car is 1.5 million. So tell me what Damilare will do and what the profit will be for Damilare.
So Damilare will not exercise the price because he can go to another place and sell the car for 1.5 million instead of just selling it for 1 million. So I think his loss is just going to be the premium of 100,000 he paid.
Okay, so any counterparty?
No counterparty, because I will not
Let
want to
me
lose.
I know you like money. Let me know what you are thinking. All right, so Damilare will not exercise because, as Ini has said, he can easily go outside and sell the car for 1.5 million. Why is he going to sell the car to Lovely at 1 million? Okay, so my next question is, what is the profit in this scenario 1?
Lovely
The profit-
gain.
100,000 plus premium. Damilare,
Sorry, take that again.
100,000 gain premium for Lovely. I said 100,000 loss premium for Damilare and then 100,000 gain premium for Lovely.
I know Lovely will know that one because she's the one who has 100,000.
Is that all, Lovely?
Yes.
Do we all agree with that?
Yes, as far as the contract, that's all.
Okay, so exactly. So Damilare would lose because he's not entering into anything. He will just lose the money he has given Lovely, and Lovely will have 100K to flex for December. Okay, so we go to scenario 2. So scenario 2, I'm listening. What do we have for Lovely? What do we have for Damilare? Michael, this question is for you. Michael, you are muted. Okay. So who has an
Yes,
answer
sir.
for me? Okay, Michael is back.
Please can you ask the question again, sorry?
Okay, we've answered scenario 1. Did you understand scenario 1?
Hello, sir.
Did you understand scenario 1?
No, I didn't.
Okay. You are not with us. Okay, so who is going
Hello, sir.
to... Yes.
I'm with you, sir.
Okay. And so if you don't... Do you have an answer for scenario 2? Or someone else should take it and explain?
No, I don't, sir. I don't.
Okay. So who's going to give us an answer for scenario 2?
Since I'm gaining, I would like to give the
Hello, sir. Can you
answer.
hear me?
Yes, I can hear you, Michael. Don't worry, someone else is
It's
answering.
okay. I said, okay. So he's going to exercise his right to sell.
We have to
Since he
Okay.
Michael, go ahead
That-
now.
Yeah,
Or
okay. I said
should.
he's going to exercise his right. He's going to exercise his rights to sell. Since he has agreed to sell at a higher price, and at the moment the underlying value of the asset is low, so he would exercise his rights to sell.
Okay. Okay, so Damilare, can you give us how much, who is gaining, who is losing?
Yeah, I'm going to gain 100,000 on this transaction. The reason is because even though on the contract I have 200,000 as a gain, because the underlying price is now 800 and I exercise at 1 million, I have 200. However, I had given a premium of 100,000 before. So less than the premium of 100,000, I'm going to have 100,000 remaining for me as gain. Loveline is going to lose only that 100,000 because she had received a premium of 100,000 before ahead from me. So Loveline is only losing 100,000 on the contract, and that's the end of the contract. I gain only 100,000. I love that. I hope it is $100,000 because you didn't put.
So I think you will take the Loveland part again. But so for your own part, you are gaining 100,000, which is first of all the 1 million, which is the exercise price, minus the price of the car in the market, which
Yeah.
is 200K. Then the
Yes.
100K you have already given Loveland.
Okay.
So
So
that's where 100K came up, Abby.
yes.
So
So for
break down
Loveline,
Loveland's loss to me.
she lost 200 on buying at 1 million. She would have bought at 800 if she hasn't entered the contract. But previously, she had gotten 100,000 premium from me, and that is a gain to her. So now she has a net loss of 100,000. That is how much she lose. $100,000. Lovely. You owe me after the class. I'll collect my money.
You owe that in scenario one, so everything is balanced. Okay, so that's good. Any questions, or does everybody understand this process? So I need you to always think about it like this, because when we start getting to questions now, CFA, they will change, they'll start using big words for you. Don't let the big words confuse you. This is the basics. Once you understand these basics, you are fine. So ask yourself, who is buying? Okay, I know the person that is buying. He's buying a call or a put. Okay, good. He's buying a put in this example. Meaning that as he's buying a put, if the underlying goes up, he will not exercise. If the underlying goes down, he will exercise. That one is not changing. You need to understand that. So let the understanding stick with you. And then based on that, you're able to calculate how much one person is gaining and how much one person is losing. I'm breaking it down here so that you can see that for Damilare, it is the exercise price minus the underlying price for him. So he's gaining that 200,000 because the exercise price is more than the underlying price. And then it's taking away the premium that he has paid. So that's the net. For this scenario one, you see, we did not even calculate anything. We did not do 1 million minus 1.5. Why? Because it's going to give us negative. And because Damilare has an option and a right, he will not use his leg to put himself in a loss position. He will walk away. So the moment the contract is looking like it's not going to favor Damilare, Damilare just walks away. So you see that we are not even trying to minimize loss or anything. We are walking away completely. So the moment we discover that this underlying price is greater than the exercise price, we completely walk away and we only lose what we have given Loveling before. So I need you to understand this, because when we get to the note now, you start saying big English so that you don't get lost. Then to the call option, For the call option, you see that when the underlying was less than the exercise price, we did not exercise. We lost only the premium. But when the underlying was more, we exercised. And we did what? We did underlying minus exercise. So I need you to see the swap. Here we are doing underlying minus exercise. For the other one, we're doing exercise price minus underlying. So you will see that as something that may look a bit confusing, but it's still your same understanding. So here, because the exercise price was 800K and the underlying is 1 million, we said, okay, it's pay me to exercise it. Or what is my benefit for exercising? Because I am buying, we now swapped it from underlying minus exercise to give us positive. For the puts, we did it the other way. We did exercise minus underlying. So I just wanted to point that out for you, so you are aware of that. Okay. All right. So we go back to this. Determine the valuation of at expiration and profit from a long or short position in a call or put option. So we have determined the value at expiration in that example. When we say whether the person exercises or the person doesn't exercise, and we've determined the profit. The profit to Damilare or the profit to Ini, which in quotes is a flip as a loss to Esther or a loss to Lovely. Okay, so unlike forwards, futures, and swaps, options are sold at a price. They do not have a zero value at initiation. If you remember, I said for the other ones, no money is exchanged. We're not exchanging money from the beginning because it is a commitment. But this one, because it's a right, you can automatically say you are walking away. Then the other party has to get something. That price, the price of this option is called the option premium. So that 50K in that our example and the 100K, the 50K in the call and the 100K in the put that we call premium are those are the price of the option at inception, unlike the other ones that don't have price at inception. Okay? At expiration, the payoff value of a call option to the owner is the maximum of 0 or underlying minus exercise. So where S is the price of underlying and X is exercise price. So what this is saying is that because it is a right, you cannot lose, you cannot get minus. So what this is saying is what is the maximum between 0 and underlying minus exercise price, which is what we did in our Excel, in our call option, where we said for the call option, we said INI will exercise when the underlying now becomes 1 million versus the exercise of 800,000. So if we are using this formula here, this formula will be maximum 0, 1 million minus 800,000. 1 million minus 800,000 will give you a positive of 200,000. So positive of 200,000 is greater than 0. So meaning that will be the value of the option, which is the 200K we calculated. The one that any will not exercise is when we now said the underlying is 700K. So this formula would have been 700K minus 800K, which is negative of 100K. So this says the maximum of 0 is greater than any negative. So this answer will now be 0. Meaning, which is what we have said in English, that INI will not exercise because INI cannot use his own rights to enter a loss. That's the English all these ones are saying here. So that's why I wanted to explain it to you there in clear numbers before we come to all this big English, which you are paying for, by the way. Okay, so the maximum function tells us that if S is less than X at expiration, the option value is 0. That is, it expires worthless and will not be exercised. That's what we are saying. So this is the formula you need to know, where the exercise price, where the underlying price is less than the exercise price for a call, which is what we have done. Does it pay me if the price in the market has reduced versus the price I agreed to buy from somebody else, it doesn't pay me, so I will not exercise my option. That's basically what this is saying. At expiration, the payoff value of a put option to the owner is maximum of X minus S. So you see this one just flips it. It flips it the other way round. Okay? For the buyer of a put or call option, the profit at expiration is simply the difference between the payoff and the premium, which we have calculated in all those examples where we said, okay, one person will gain 200,000 and he will lose the premium of 100,000. So his net gain is 100,000. That's what this English is saying here. So your profit is that net gain, which is what I have gained from the contract, less any premium I have paid to the other person. Because the seller, which is Esther or Loveland, receives the option premium, the profit to the option seller at expiration is the amount of premium received minus the option payoff at expiration. The writer loses the payoff at expiration and we have a loss on the option if the payoff is greater than the premium received. It's still the same English we have said. Okay? So the key thing I want us to also look at here is this. So the risk exposure to two of them are different. So if we go back to our examples, let me just go back to that. If we go back to our examples, in this call where we said Ini is buying, Esther is selling, the question is, what are the risks that they are both facing? So what risk is likely to happen in the call option? So if we look at this, we say Ini is buying at 800,000. Scenario 1, we said he will not exercise, so that one is gone. But let's look at scenario 2. So in scenario 1, the only amount that Ini can lose in this contract is 50,000. So the maximum risk Ini is exposed to in this is the premium. That's what this is saying. Is that clear? So no matter what the price is, Ini cannot lose more than this 50,000 he has given Esther. No matter the scenario, because he cannot pay Esther more. He can only lose this 50,000. So even if this underlying price becomes 0, it's still the 50,000 that he has given Esther that he will lose. Do you guys understand? Now, okay. So that is the maximum risk for Ini here. For scenario 2, and of course, in that same scenario 1, the maximum benefit for Esther is the premium. Because if she can't even gain any other thing. Because there's no other way, there's no way that Ini will bring in more money other than this 50,000. The best Ini will do is walk away. So the maximum Esther can gain is 50,000. But for this scenario 2, which is where it becomes dicey, let's assume that this underlying price moves to 2 million, for example. So you see why that price limit is important. So you see that the price has moved to 2 million. Ini will gain 1.1, which is 2 million minus 800K, which is first the 1.2, then the 50K he has given Esther. So he will gain 1.1. So Esther has to go and look for, Esther will lose 1.1 million. Esther will even lose more than the 800K that they agreed. So what is this trying to tell you? It's trying to tell you that there's no limit to how much Esther can lose. Esther's loss in this example is unlimited. Sorry, the seller's loss. Let me stop saying Esther's loss. The seller's loss in this example is unlimited because this underlying price, we can keep increasing it. If we increase it to 10 billion, it's the same way this loss will keep going up. Now you see why that price limit we spoke about at the other side is very important. Because if not, where would this person see extra 1 million to be paying INI? And of course, nothing concern INI. If they like, the price in the market should go up to 15 million. INI will just walk in majestically with his 800K, nothing more, nothing less, and expect his phone. If they like, the phone should be worth 10 million. It's not in his business. It's Esther that will go and be looking for the balance. So the loss to the seller is unlimited. That's the issue here. So the loss to the seller is unlimited here. That's for the call. Is that clear? Before we move to the put.
Yes. Okay. That's because the seller is going short on the option. Am I right, sir?
Yes.
Okay. Thank you.
Okay. So that's clear. So now for the put option. For the put option, so we now look at the scenario 1. For scenario 1, we said he will not exercise it because this is greater than this anyway, so that's fine. So it means that the loss, the maximum loss that Milari will face is 100,000. The maximum gain Loveling will get is 100,000. Now, we now move to this scenario 2. So for scenario 2, please follow me carefully. Remember we said because this underlying price is lower, because this underlying price is lower than the exercise price, that is why Damilare is exercising it, because he has discovered that he can sell the car for 1 million compared to 800,000 that the market is going for. So meaning this one will keep going down. So let's assume it goes down to 400K. So you see that the maximum gain Damilare can gain is 500K, and the maximum loss Loveling will lose is 500K. So let's assume that the asset is, for just the sake of argument, is 0 naira. So you see that at the end of the day, the maximum Damilare will gain is that exercise price that he agreed, which is this, minus the exercise price minus the premium. So Damilare cannot gain more than that 1 million he has agreed to sell the car. And Loveling cannot lose more than that 1 million minus the premium, of course. So do you understand? So for the put option, there is a cap to how much one person can lose. But for the call option, there is no cap because it can keep going up. So the loss of the seller is almost unlimited in theory, because assets, there's a limit to how much the assets can go up, basically. So do you get the point? Is it clear?
It is.
Yes.
All right.
I can't see your screen. Okay.
Okay. All right. So that's what this is talking about. I just wanted to explain that. So note the risk exposure of call and put buyers and writers. The buyer of a put or call has no further obligation. So the maximum loss to the buyer is simply the amount they paid for the option, which is what we spoke about there, about Damilare and INI. They cannot lose more than what they have put. So you as a buyer, whether you buy the put or you buy the call, you cannot lose more than what you have put, more than the premium you have paid. But the seller, which is the other party, of whether it's the call or the put. So the writer, so we also call them the writer. So Loveling and Esther are called writers as well. So we call them seller, we call them writers, and we also call them counterparty. So the writer of a call option has exposure to an unlimited loss because the maximum price of the underlying is unlimited theoretically. So for the call option, the seller of the call option does not have a limit. So the loss can be unlimited. But for the put, so the payoff on a put option, so if the lower limit on S is 0, the maximum payoff on a put option is the exercise price. That's the one we said. So the maximum loss that the seller can get from the put option is the exercise price. So the maximum loss Loveling can get there is 1 million. She cannot lose more than 1 million. But in the other example, Esther can lose a lot more as far as the asset keeps going up. The underlying asset keeps going up. Okay, so profit and losses for call option. So this is just an example to buttress what we have been talking about. Let me just take this. Consider a call option with a premium of $5 and an exercise price of $50. So I think we should see if we can answer this. Consider a call option with a premium of $5 and an exercise price of $50. This means the buyer pays $5 to the writer. This is the premium. At expiration, if the price of the stock is less than or equal to $50 exercise price, the option has zero value. The buyer of the option is out $5 and the writer of the option is ahead $5. When the stock price exceeds 50, the option starts to gain. Break even will come at $55 when the value of the stock equals the exercise price plus the option premium. So in our example, where we spoke about the call and the put. So the break even is the situation where one person is not losing, the other person is not gaining. So in this case, you have premium of $5 and the exercise price is $50. So if the underlying is 55, it means 55 minus, because if the underlying is 55, it means the person will exercise it. If you exercise at 50 and pay the premium of 5, so 55 minus 55, one person is not gaining, one person is not losing. So conversely, as the price of stock moves upward, the seller of the option starts to lose. Negative numbers will start at 55, blah, 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 blah. Okay, so this is just to buttress what we have spoken about. So I will just, same thing for puts. I will just scroll through that. Yes. So I want us to do this one. All right, so let's answer this. So the question says there's a call option and a put option on a stock. The exercise price is $40. The current stock price is $42. The call and the put premiums are $3 and 0.75. What does that mean? It means the premium for the call is $3. The premium for the put is $0.75. Calculate the profits to the long and short positions for both the put and the call with an expiration day stock price of $35 and with a price at expiration of $43. So first question I will ask, do you understand this question? If, for example, this is a question you're giving in exam, do you even understand it first? And can you relate it to what we have done? Let me even ask that first. Is the question clear or is complex?
I think it's similar to that Excel example we did.
Okay. So
But it's the
everybody,
English that trained me up.
exactly. So I want to be sure if everybody is comfortable with this question or the English is beginning to turn your head small. Because in CFA, these are some of the questions you will likely see. Okay. So let me explain the question further for those who may not be comfortable with the question. So the question is saying that there are two things you should calculate. there is the call option, and there is the put option. And they have said there are two prices. So the underlying price, they've given you two prices. So you answer the first question is, if the underlying price is $35, what will happen with the call and what will happen with the put? The second question is, if the underlying is $43, what will happen with the call and what will happen with the put? Also, in that question 1 and question 2, the same way we did in our Excel, just like Ini said, I looked at what happened to Ini and I also looked at what happened to Esther. I looked at what happened to Damilare and what happened to Loveland. I did not just look at one person. So that's what this question is saying. So the question is saying, look at the two parties under the call at a price. Look at the two parties under the put at a price. Okay. So I'll give you 5 minutes to answer this. Since nobody has any questions, so I'm waiting for answers.
Aisha, I think I need clarification on this question. Hello, can you hear me?
I can't hear you
Okay.
because when I asked you if you have question, you do not have question. Now you have entered
No,
middle
it
of the
just
question.
it,
You're asking me
no,
question.
it just a
Clarification
one
is a
sentence
question, sir.
clarification.
It's still a question. Continue with your thoughts. I will answer you at the end.
Okay, all right. Right, maybe I should go first with my thoughts, my line of thinking.
Thank you, my brother.
Okay. All right. So yeah. So the long position here will mean the holder of the call option, while the short position will be the holder with the put option. Then the exercise price is $40. The call option, the holder of the call option has paid a premium of $3. And now me, I've taken this $35 as the underlying value of the assets for the put option, while the $43 as the underlying value of the assets for the call option. So if that's the case, if the exercise price for the holder of the long position is $40 and the underlying value of the asset is $43, then he will not exercise the option. Then if he doesn't exercise the option, his maximum loss will be $3. And why?
Sorry, take that again. Sorry.
Okay, all right. So if he doesn't exercise the option,
Which option?
That
is
is
it
the
the
call option.
Or okay.
The call option, yes.
So the call at $35, right?
No, the call at $43.
Okay, call at $43. Okay.
So if he doesn't exercise the option, his maximum loss will be the $3 premium he has earlier paid, while the seller's maximum gain will be the $3 premium he had earlier received.
Okay, so okay, so first of all, that's why I wanted to explain the question. The question is saying that the 35 and the $43. So the $35 is both a call and a put, and the $43 is both a call and a put. So you should have 4 different answers, basically.
Scenarios.
Four
Four
different scenarios. Okay,
Yes.
okay. I think I got it a bit, if that is it.
Okay, can I try, sir?
Because
Okay,
hold on, sorry, hold on.
Okay, I should hold on.
Yeah, hold on. So Michael, you would have been right if they had put respectively in the question. So if they had said with an expiration date stock of 35 and a this of 43 respectively, then you can say 35 is put, 43 is call. But without respectively, you have to assume that they are saying option 1, call 35, option 2, call 43, option 3, option 1, call 35, put 35, option 2, call 43, put 43, basically. Then I also think your answer was not correct, or maybe I didn't hear you properly.
Yeah.
Because you said call option if the price is at 43 that you will not exercise. I think that's what you said. Am I right?
Yes, that's what I said.
Hello, sir.
Okay.
Yeah.
All right.
Okay.
Okay.
I think one thing I always do, because I know call and put can be confusing, is I always put it down. What is a put option and what is a call option? I put it down. Put option, the right to sell. Call option, the right to buy. They are now started my scenario. Scenario
Okay.
1, for a put option, scenario 1 is who is the buyer will not like to sell at 35. If at 35, no, he will not want to sell. And that means what he's going to be losing will be the $3 he has put forward for the option. Whereas the seller, because he did the put for the put option, the seller is at mercy of the buyer. So he will only gain the $3 since the right is not exercised. Now, on the second scenario for $43,
Before you go to wait, the first scenario you mentioned, is it 43 you said?
35 at $35. That's the first
At
thing.
35, will he
On
exercise or
expiration,
not
if the
exercise?
price, he will not exercise. For a
For
put
puts.
option, yes, he will not exercise. The
Ah.
price is lower compared to the exercise price.
He would not exercise.
He will not exercise.
Hmm. I'll come back to you before you go to your
Okay.
next scenario.
I think
So wait, so
okay.
everybody pick. Wait, so I will give you all a chance. You should have either 4 scenarios or 2 scenarios in your notes. Pick the scenario that you are very certain of, because I won't have time to ask you to explain all your 4 scenarios. So just pick one scenario that you are very sure of and put that one as your best foot forward. Loveland, do you want to go?
Yeah, I want to say something. So at 35 naira, the
Is this
long position is
your
going to
best foot
lose 3.
forward?
It's going to lose 3.
Is this your best answer of all the options?
Can you hear me?
Yes, I can. Can you hear me?
For the first scenario, So for at 35 naira, for the call premium, the long position is going to lose 3 naira or $3. Then the short position is going to gain 3. That's the premium.
No. Okay. So
Long position at 35. Wait.
I'm
No,
waiting.
it's not correct, please.
Okay.
It's not correct.
Get back to me. So let me explain how I want the answer to be so that it will be structured. So you first tell me the scenario. So I've said there will be 4 scenarios. Scenario 1 is call. A call where the price is $35. Scenario 2 will be a call where the price is 43. Is it 43? $43. Scenario 3 will be a put where the price is 35. Scenario 4 will be a put where the price is 43. Those are the 4 options. You only have a chance to explain one of those options to me. You can pick any one, just the one you are very certain of. Now, your answer would be like this. Your answer would be, for example, I am going with call option, price is 35. That's the example I'm going with. The buyer will exercise or the buyer will not exercise. That's the first thing you will tell me. You will now tell me that if the buyer will exercise, the buyer will gain X. The seller will lose Y. That's the structure I need from your answer. After giving me that one so that we all understand what your answer is, then you can buttress your points. Are we good? Who is going first? Or should I give you more time? Even though time has gone. Michael.
Let me go first. Yes. Okay.
Okay,
So
please follow the structure of my answer.
okay. So the first scenario, call option at $35.
Good.
Okay. Yeah. So the buyer will not exercise, and if he doesn't exercise, his maximum loss will be the premium of $3 he had earlier paid.
Okay,
For
and
the seller, the maximum gain will be the premium of $3 he had received.
Okay. Do you want to buttress it or you are fine with that? We should go and move on with our lives.
Okay. Yes. That's because he had agreed a price that is higher than what the current value of that underlying asset is. So he can get that asset at a cheaper price outside the option he has agreed to.
Okay. All right. I won't answer whether anybody's correct or not yet until I hear from everybody. Because somebody else, the person's best answer may be this same option you have picked. So I'll just note it. Michael says call at 35, not exercise. And then profit is $3. Loss is $3. Profit to the buyer, $3. Loss to the seller is $3. Right? Okay. So
Okay, let me come next.
all right.
Yeah, I've seen. I put some figures ahead of each other. I think that is why I made a mistake initially. Now
I didn't tell you made mistake initially.
I understand. I've seen it.
Okay.
I've seen it. So that is why you didn't tell me. So
All right.
I'm still on my position.
Which is
Put option. Exercise
okay.
price 35.
Put 35. Okay.
Okay. Under that person, the buyer of a put option will not exercise the price.
Not exercise. Okay.
So there is going to have sustain a loss of $0.75.
The buyer lost
Whereas
0.75.
the seller will gain the premium, which is $0.75.
Okay. Final answer.
Final answer, nothing more,
All
except
right.
you want you to explain further.
It's okay. Explain further.
Okay. The reason is because for put option give the seller the right to sell, whereas the exercise price is 40. He will not be able to sell at 35 because that would be lower for him, when actually he can sell to another person at 40. So he would not exercise his right to sell.
Okay. Inni and Lovely.
Wait,
Do you have
can
anything
I
for
try?
me? Okay. All right, please.
Okay, this is new. This is not lovely.
Yes, I know.
So the long, I want to try for the long guy on puts. I mean the okay, the puts for long position.
Okay.
So
Which is
when
how
the
much?
for 35,
Put at 35, okay?
okay, for long at 35 put. So he's not going to exercise the option and he will lose his premium that he paid 0.75.
Okay, so your answer is basically the same as that Melari's answer.
Okay. Yes.
Okay.
Then at 43, he's not going to exercise it, but he's going to go somewhere else and sell it for 43. And he will not gain that 3 minus 0 points. Sorry. Yes, he will gain 3 minus 0.75. That is 2.25.
Lovely. Thank you, Uni. Lovely.
Okay, so I'm going with the puts premium at 43 naira.
Okay.
So the short position will exercise right and sell at 43. This will exercise right or will not exercise right confuses me. So let me just say this short position will sell at 43. I don't know if that is exercise right or will not exercise right. And then it's going to gain 2.25. That's 43 minus, sorry, that's the premium minus, what am I saying? That's 43 minus 40 minus 0.75. That's his gain, the 2.25. Then the long position is going to lose 2.25. That's at 43, put a premium of $75, of $0.75.
Okay. So if you guys remembered, I think what is confusing all of you is, thank you, lovely. I think what is confusing all of you is first of all, the long and the short. And then the several scenarios. Which is why I said, do you people understand the question? Because this is what CFA does. When I explain the answer now, you'll be, yes, you know the answer. But CFA will always try to, like I said, use big words to confuse you. Don't let them win. Always go back to the basics. And the basics is asking yourself one or two questions. So let's take it together. So I don't think anybody got the right answer, by the way. So let's look at the answer. Okay. So, okay, before we go to the answer first, let me explain the question first. So there are several things in the question. Like I said, there are 4 different scenarios. So let's take it one by one. There's a call option. The call option is I want to buy something, right? I'm going to buy an option. I'm going to buy a call option that will give me the right to buy. So what you need to understand one leg. The other leg is just the opposite of this leg. So don't let the long and the short position confuse you. I am going to buy a call option. And we said long is to buy. Excuse me. We said long is to buy, short is to sell. So I'm going to buy a long. I'm longing a call. I'm going to buy a long position. I'm going to buy a call position. So you need to ask yourself, before we go to the answer, let's use 35 first. Let's forget all the long and short stories. If I have agreed an exercise price of 40, for a call, it means I am buying, right? So meaning that if I say I want to buy something at 40 naira, is because I believe that the price will be higher than 40 in the future. Therefore, I'm going into a call today. So if I take the first example, if I say, okay, 35, if the call is 35, the expiration price is 35, meaning the value of the stock is 35 naira. But I had planned to buy it at 40 naira. Will I exercise or will I not exercise? That's the question you should ask yourself first. Leave all the English. That's the first question you should ask yourself. Does it make sense for me to go ahead to buy something at 40 naira that I now see that today they are selling it in the market at $35? That's what you need to ask yourself. So in that case, I will not exercise. So not exercising or exercising, lovely, is either going ahead with what you have agreed to do from the beginning or not going ahead. So I have agreed to buy stock at $40. And now I've realized that in the market, that same stock is now $35. I will not buy it again. I will prefer to go to the market and buy it at $35. So meaning in that case,
Sorry,
I
please,
am
just to be clear.
okay.
So does that mean that when I say the buyer will not exercise the price, it simply means that the buyer will not go ahead with the price or something?
Yeah, so
I really don't understand
it
that
depends on
statement.
the put. Okay, so it depends on the put or the call. So if it is a call option, remember the call option from the beginning is that you will buy, right? So if you
Yes.
exercise, it means you will go ahead to buy. If you don't exercise, it means you will not buy again. But for a put option, which the original transaction is to sell, if you exercise, it means you will sell. If you don't exercise, it means you will not sell again. So you need to ask yourself, what option am I looking at? Am I looking at a call or a put? So exercising means going ahead with what I have said I will do. So a call is I will buy from the beginning. Exercising means I will go ahead to buy. Not exercising means I will not buy again. Do you understand?
Yeah, thank you.
Okay. So Michael is even off the call. I think Michael is the only one that even got it. But let me see if okay. So the call at $35. The price, I said I want to buy at $40. And I've seen that in the market, the price is actually $35. So I will say, okay, sorry, I told you I was going to buy before. I am not buying again. Not buying again means I am not exercising the option. So meaning at that stage, the only thing I'm losing is my premium. And my premium in that example is $3. So that is on one side. Now let me go to the one you people all answered, which is the put. Now, the put originally is that I want to sell, right? So if I decide that I want to sell, and I decided from the beginning that I want to sell at $40, why am I going into this contract? I'm going into this contract because I believe that in the future, the price would have come down. So because I know the price will have come down, that's why I'm going into this put contract. So what am I doing here? It is now saying, so if we use 35, I think you guys, okay, Damilare and Ini use 35. So if I go to the market and I say that, oh, the price in the market is $35, or the price I agreed to sell is $40. I have to go ahead with selling, because selling, I'll be able to sell at $40 compared to if I go to the market and sell at $35. So I will exercise my option because my option pays me. So I will say, I want to go ahead to exercise it. The person I say I'm going to sell to, oh yeah, it's time to come and buy from me, or come and buy at $40. So at that point, The put, I am gaining 40 minus 35 because $40 is how much I'm going to exercise the price minus the $35, which is the price in the market. That will give me $5. Then what is the premium I paid on that put? I paid premium of 0.75. So I have gained $5. $5 that I've gained minus 0.75 will give me 4.25. That is the gain I have gained on that put of $43. Sorry, on that put of $35. Sorry. Because I have decided to exercise because it pays me. Damilare and Ini, do you understand that?
Yes, thank you.
That's what you say until we go to the next question. Okay, so so Lovely answered put 43. So let me explain that. For the 43, so I said I'm going to sell, right? I'm going to sell. I agreed I'm going to sell at $40. But now I've gone to the market and I see that market is selling at $43. Oh. It means I will not exercise. Meaning I will not go ahead with the initial plan of selling at $40 because I have seen a better market. So what will I do? I will not say, okay, sorry, I'm not going ahead. I prefer to go outside. What does that mean? It means that the only thing I will lose is the premium I have paid because I'm now going against what I agreed I was going to do before. So the only thing I will lose in that case is 0.75, which is the premium I have paid. So let me go to the answer. Lovely, do you understand the explanation now?
Do.
Okay, so let's look at all the different scenarios. So like I said, you need to understand. Don't let the English confuse you. They are here to confuse you, but you need to understand what it is that call and put means normally. So, okay, let me read the answers and then you guys will tell me where the confusion was. Okay, so profit to be computed as ending value minus blah, blah, blah. So stock at 35. So this first one is saying if the value of the stock is at 35, a long call, which is you are buying at the market price is 35. So this means that the option has no value. So the buyer loses the premium paid. What does this mean? It means that I have agreed, excuse me, you have agreed to buy the option. The underlying is less than the exercise price. So you have said that, okay, I'm going to buy. But you now see, price in the market is 35. Price in the option I entered into before is 40. I cannot go and buy at 49 when I can buy at 35. So what do? You will say you will not exercise the option. So not exercising the option means that the option has no value because you are not exercising it. It's zero. So if the option has no value, or if the option is zero, it means that you will only lose the premium because now you are not exercising it, meaning you are not going ahead with what you said you were going to do before. So meaning that the only thing you are losing, the buyer only loses the premium. So long call is that the buyer loses the premium. Short call is the opposite. It's just they're just speaking English, long and call. Sorry, long and short. The long call is the person that bought the call. The short call is the person that is selling the call. So which is the other party? As we use them, Ini and Esther, Damilare and Loveling, the two parties. So where one person is losing $3, which is the premium, the other person is gaining the premium. That's the first two. The second two is long put, which is long means you are buying. somebody is buying a put option. The person buying a put option is the person that is saying, I want to sell. So I want to sell at $40 in my exercise price. That's what I agreed with you before. But the market is selling at $35. It pays me to continue with my option. Therefore, I will exercise my option. Now, in exercising my option, I will gain something. I will gain 43. Sorry, I will gain 40, which is the exercise price, minus the underlying value, 35. So I will gain $5. Then I deduct the premium I paid you, 0.75. That means my gain as the buyer of the option is 4.25. Automatically, the person that sold it to me has lost 4.25 automatically. And that's what you now call the short put, because that's the seller of the put to me. And then the time is fast spent. And then the $43, the stock at $43, long call means I am buying. So if I decide to buy at $43, remember I'm buying, and I have agreed that I will buy at 40, and I see that the market is 43. Therefore, I will exercise. So in me exercising, I have 43 minus 40. So I have a gain of $3. But now that $3 gain I have, sadly, the premium I paid on this call option is $3. So meaning I have a net of 0. So this is the break even I was talking about. Me that bought the call, I will not lose, because the money $3 I've gained, I've lost it in the premium. Then the person that sold the call to me will receive $3 from me as premium, but we also spend $3 to go to the market to buy this underlying for me. Automatically, 3 minus 3 gives us 0. So no gain, no loss for him. For the puts, I am selling long puts. Long put, I am buying an option to sell. So long is buy, put is right to sell or option to sell. So I'm saying, okay, I want to sell. And I agreed to sell at $40 before. But now I see that the price at expiration, the price at expiration is $43. So what would I do? I will not sell at 40 now. So I have to cancel our contract. I have to go with the market. So I'll say, okay, sorry, option cancelled. But because I've paid a premium of 0.75, that's the maximum amount I will lose. And then in reverse, that's the maximum amount the seller will gain. And that is that. So even though we don't have a lot of time, I want to know where the confusion came from. Damilare, Ine. But I know if I ask now, you say you
Okay, for me, I
understand.
think it's the time. And
No,
because
me,
in my book, I got
Sorry, Ine, Loveland, continue. Sorry.
okay. So for me, in my book, I got the long position
I
at
can't hear you.
$35, and then the long. So I got in my book what I wrote down. I got the long
Okay.
puts at 43 naira, and then the long call at 35 naira. So for the long puts, I think I mixed it up because I did the subtraction. I got 2.25, and then I think time, so I was tensed or something. But thank you, it's understood now.
Yes. So you were on the right track when you were giving me that long put, but when you started giving me 2 point something, I knew that something happened somewhere. So that's good. Clear, very good that you understand. Ine?
I got the call for the call parts, but the thing is, I mistook the whole thing. I think the question and the number scared me, so I still don't get your explanation. Maybe I'll go back and read it, or I'll rewatch the video. Well, I
Okay.
think I'm just scared of it's a question that's making me misinterpret everything.
Okay. I'll answer your once I'm done with Damilare. Okay, let me even answer for Damilare. So That's why I said, remember when this question came, I asked you people. There was a reason why I asked, because the question originally is confusing. And it will just take away your time and you start thinking other things that you should not think about. Which is why you need to understand. So you see the way I've tried to break it down. Let's even not look at it. Look at call and puts. So the long and short, anywhere you see long, you know somebody is buying. Anywhere you see short, you know somebody is selling. And you also know that for everything somebody is buying, somebody has to be selling that thing you are buying. You can't sell to yourself. So when you answer one side, you know that you've automatically answered the second side. Once you answer one side, you know you've automatically answered the second side. And then there were plenty of numbers, so I can understand the confusion. So maybe you take time to rewatch the videos and even also look at it. But key point is understand that a call is a call. And you need to ask yourself, if it is a call, why would I exercise a call? And why would I exercise a put? That's the first question you need to ask yourself before you even enter any question of call and put. That thing has to be in your head. You need to find a way to remember that. I will exercise a call because of this. I will exercise a put because of this. You need to have that first. When you now have that, you can now enter the question to say, okay, in this question, the reason I said I will exercise the call, is it here? Oh, it's not here. Therefore, I will not exercise. And then vice versa. Okay? Damn, Larry.
Yeah, Mr. Chooks, you've explained it all. So I will sit down with it and get back to you. I think my confusion comes from in applying my logic for it. Is it I'm not wrong with the put and the call. I used to explain it that I put down, but I think in applying it I mistook something for themselves, and that is why I noticed I was
Exactly.
wrong when I was trying to say it out. No, it should be the other way around. So I got it. I got that I was wrong at the point here. Thank you.
Exactly. Because your explanation was, when you were giving me your explanation, it was clear. So
Yeah,
you
yeah.
understand call and put.
Mm-hmm.
But something just happened somewhere, Sha.
Something happened. I just miss it together again.
So
Thank you.
I think you guys should take time and go over it, because it's once you get the concept, it's easy. So it's okay. So that is that. We've spoken about this one before. Okay. Let's answer number 5. But we'll explain number 5 before you answer it. But I want us to answer number 5. So for number 5, we are looking at so let me read the question. An investor writes a put option with an exercise price of $40 when the stock price is $42. The option premium is $1. At expiration, the stock price is $37. The investor will realize what? So, because of time, let me explain. The investor here is not the buyer of the put, is the seller of the put. So, using that understanding, what's your answer?
You realize $1. That's it.
Okay. Any other answer? Okay. So let me explain. So remember, this is the person selling. He's selling the put. So this question is trying to confuse you because it's coming from the other side. So he's selling the put. What does that mean? So let's, like I said, when you see any question like this, step back and ask yourself what a put means and what will make somebody exercise it. Until you take those steps, these questions will keep dribbling you. So once I see a question like this, an investor writes a put option with an exercise price of 40, stock price is 42, option premium is 1. At expiration, the stock price is 37. The investor will realize, okay, so I ask myself, okay, this is a put option. Meaning, if I'm buying this put option, I'm buying it because I believe that there will be a price reduction in the future. What does that mean? I've put an exercise price here of $40. And now, meaning I plan to sell, is a put option. I plan to sell at $40. But now, the value of the stock is $37. So if I'm the owner of this put, will I exercise or not? That's the first question you ask. I will exercise because I can sell to this investor at $40 compared to selling outside in the market at $37. So automatically, on the other side of the put option, which is me buying the put option, I will gain $3. So because I'm gaining $3 already, I have paid a premium of $1. So my total gain is $3 minus the $1 premium I've paid. So my total gain is $2. So if me on this side is gaining $2, automatically the person on the other side is losing $2. And I have my answer, which is A.
Mr. Chuk, this thing is confusing. Oh.
Yeah, because what I understood was that the investor writing the put option, the put option is option to sell or not to sell, right?
Yeah, yes.
So the investor writing it is the one that has the premium already because it's selling the
Yes.
option to the seller.
Yes.
So that means
Fantastic.
the investor already has $1. So now
Fantastic.
the price has gone down to 37 naira. So the seller will not want to sell at 37 naira. Now that was how I interpreted it. That the seller will not want to sell
Very
at
good.
37 naira, and
Very
therefore
good.
the investor, and because it's not selling, the investor already has $1, and that is his profit.
No, so you are right, but you didn't finish your thought process. You are right in the sense that the investor has $1. Tick. You are right in the sense that the stock is at 37, which is lower than 40. So the person will not want to sell in the market. Tick. But remember that you have given somebody an option to sell at 40. So that person, what do you want that person to do? Would you think that person want to exercise the option or not? You get. So because it pays that person to exercise the option, the person will come and meet you and say, Madam, I'm selling to you at $40. You must give me $40 today. So the moment you give that person $40, you have lost $3. Then you remember that $1 you put in your pocket. That's net. That $1 is what has reduced your loss to $2. Do you understand?
Yeah. Yes, I do.
So
Thank you.
you're welcome. So I think you guys, maybe because it's evening, so everybody's head is it's already in resting mode. So take some time, try and understand this. If you ask me, or another way for you to understand it is try and use examples that relate to you. Just scribble examples down and try and see if that ties with an example you have in the notes, if it is the same conclusion you get to, because that helps as well. And understand the way I'm answering the question. Before I even enter the question, I am asking myself whether it is put or call in the question. What does it even mean? What am I going to do? Because that's what we did in that Excel. I will always, in fact, if you ask me, I will follow that whole process before I even come to know what the question is asking me. Because originally I will arrive at $2. So you see, I've arrived at $2 profit for the person that buys the put, even though the question is asking me what would the person that sell the put get. So if I know what the person that buys the put will get, which is the easier one, automatically I just flip it to know what the seller will lose. So it is basic. Once you understand the steps, then you are able to answer any of these questions. So thank you guys. Take some time, read, and we'll see next week. Any question? Any other question for me?